solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? You know, the why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible, and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
DOJ or other authorities
could face bigger challenges next.
Was going to keep rate World Cup. This is a 3.
As the economic picture does.
The BOK is getting ready to make a decision.
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Our core view is still one where you're going to see economic growth resilience.
Yield curve is a very powerful signal that we might be seeing a very big slowdown in the economy.
I'm not sure that disinflation the market was really grabbing onto at the start of the year is necessarily going to come through.
Over the second half of this year, you are going to see the consumer pause.
I think that markets are trying to sort of, frankly, start ignoring 2023. I think people are ready to get past it.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Coming up on Capitol Hill, the most powerful man in financial markets worldwide, Chairman Powell, a little bit later this morning on Capitol Hill, live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance. Equity futures up by a little more than 0.1% on the S&P 500. TK, it's over to you. Jay Powell, a little bit later.
Jay Powell, be interesting, always interesting in the two testimonies. I'm sorry, old fogey, that's Humphrey Hawkins. And the answer is the Senate will be more collegial. Even the senator from Massachusetts will speak with grace, less yelling and screaming. And then at the House tomorrow, I think you'll see a lot more emotion.
Andrea Hollenhorst, the city, says it comes down to this. Perhaps the hawkish or dovish takeaway may instead depend on how strongly he endorses the path of hikes now priced. What are we looking at right now, Lisa? 540?
7.
Yeah, 550, almost 550, basically.
Let's see what Friday brings.
Exactly. Well, 550, and it's been hovering around there, 440 to 550 by September. So how does he endorse it? This is my question. What is he looking for, and how long could they hold rates at that level? To me, how much does he express concern about the fact that inflation data and employment data has come in hotter than people have expected for many consecutive readings?
If we just said what you just said a year ago, 99% of our audience would say Dow 20,000, S&P 3,000, 2,800. Why are equities up with this spike in yields?
I think we should frame where we were 12 months ago as well, Tom. Still doing QE coming into March, rates at 0. I think if someone had said 540 And you laughed and joked about 7, and some people scratched their head, well, maybe 6 plus.
Yes.
12 months ago, that was kind of unthinkable,
Right.
Lisa.
It was a far-fetched idea. Now people are saying, well, if you actually follow the Phillips curve, we could get to 8. I mean, you have people gaming this out based on different models. The point is, we're in a different reality, and even with yields where they are, even still, inflation is surprised to the upside. So are we going to hear about long and variable lags today? Are we going to hear about just trying to break something? Are we going to hear about financial conditions and his concern about the fact that stocks are so resilient?
Long and variable lags.
No, he's not.
Long and variable lags was Team Mercedes at Bahrain.
Yeah, there were some longer variable lags.
Yeah,
there were some very long lags.
Long and variable lags.
Some 2-minute lags, which in central bank speak is like 2 years. Anyway, equity futures right now, positive 0.1%. Let's whip through this just briefly. 3-day winning streak into Tuesday. You hear from the chairman in about 3 hours from now. Lisa will give you the times of everything in just a moment. Yields come in a couple of basis points. Your 10-year 393.43, euro dollar 106.56. We're negative 0.2%. I do want to talk about some ECB speak a little bit later because, Lisa, we've heard from so many hawkish voices in the last day or so.
Yeah, ECB's Holtzman coming out and expecting that perhaps we could get to 4.25 on the ECB main rate. Just sort of unfathomable based on where we have been in that region. Here's what we're watching. 8 a.m. we talk with Mike Wilson of Morgan Stanley, the chief U.S. equity strategist there, about Tom's question. Why aren't stocks reflecting what we had expected they would do in the face of rates that are much higher? Why have we not seen a reality between the fundamentals and the price action, or are we, right? And so we've talked from Greg Bottle over at BNP Paribas, and he was saying he could see a 16% downside in equities. I think Mike Wilson is sympathetic with that view. What could make him change it? At 10 a.m., we hear from Fed Chair Jay Powell. He is testifying ahead of the Senate Banking Committee, as John and Tom are talking about. 9 a.m., we get the comments released ahead of it, so perhaps we'll get some indication of where he plans to go, or maybe it'll just be some sort of antiseptic comment that gives him leeway to say whatever he wants. And at 3 p.m., we get U.S. consumer credit. Are people still borrowing to spend? And this to me is one of the main questions. How much more dynamism is there left in the consumer spending engine that has fueled U.S. economic growth, that has fueled some of the inflation that we see in services in particular? Is there a beginning of some sort of restraint, especially as rates go up and as people get a little bit more concerned about what's to come, John?
Elisa, thank you. Let's get straight to it in the equity market. Anna Han, equity strategist at Wells Fargo Securities, joins us now. Anna, always wonderful to catch up with you and good to see you. I want to start with that line you started the week with over at Chris Harvey and Wells Fargo. Do not trade as if we're in a bear market. We're not. Anna, what does that mean?
Well, we spoke about earlier this year how there was a fear of the bear market, another repeat of 2022. But to us, we don't see those same signs. The Fed has slowed down considerably. Credit markets stay healthy. The consumer continues to spend, and wages are continue staying strong. This is not the signs of a typical bear market. At the same time, we're not expecting this massive bull rally either because we don't quite see the catalyst there. So rather than trading fearfully and too defensively, we're still on the offense here looking for opportunities in the equity market.
So, Anna, just to be clear, this is another way of saying October was the low for you. That was the low.
We won't say it's the ultimate low. We do think that equities can drop lower, but for us, it would take a lot to see those October lows again. It would have to be a quite extreme case. And part of that right now, we don't see it lining up that way. Now, we always love to talk about tail risks, but our base case scenario is that in the near term, we see more upside for equities.
And I want to go away from your quantitative analysis and go to what you think is fundamentally going to happen in corporations. I know your love for Team Mercedes and you, Louis and George, just want to go faster. Are corporations going to be able to go faster given high interest rates? Are they going to adapt and adjust constructively?
I think they're still going through those growing pains right now, and they're really wondering if the consumer starts to weaken, can they make those changes effectively and in time? So for us right now, what they're showing is that they're passing along price. They continue to, but almost across every industry, except for a very select few, you are seeing that volumes are down, and that price elasticity is really biting into margins consecutively quarter over quarter.
This is brilliant. I want to talk to you about the elasticity of profit-making, free cash flow, stocks. Really, I know you like mid-cap growth a lot, but there just seems to be a massive skew in the market. I'm using it as a general phrase, a massive skew between those making money, the haves, and many, many others, the have-nots. Is that how you see it?
Well, there is certain extremes. You are seeing those industries, especially now that we are a couple years out of the pandemic, they're not so much that stay-at-home trade. We've also seen structural changes in people's preferences now coming out of the pandemic. Not as many people working full-time in the office. These structural changes, again, need time for corporates to really swallow and learn and grow from that. At the same time, even with slowing earnings and corporate growth, we are seeing positives for the equity markets because we continue to see that in the yields market that people continue to believe in growth. You're seeing real yields continue to go higher even as inflation expectations are repricing. So these are the kind of good and the bad things you're seeing that you mentioned.
So where does this shake out in terms of what the ramifications will be for equities going forward as we see rates perhaps go higher and stay there? Are you on the Greg Bowdle idea of things where you could see perhaps 3,400 in the S&P, or are you saying that we basically aren't going to retrace that much? We're basically seeing a new reality and people have adapted and adjusted.
Lisa, I think that 3,400 you mentioned, you need to see some sort of shock to the system. You need to see some very spiking in credit spreads or in yields, and you need to see a spike in inflation readings or a aggressive drop in the labor market. And right now, that's not our base case scenario, something we certainly are cautious of, and we're looking left and right and watching all the indicators for. We're not quite seeing it. So in the near term, we think actually things line up a little more positively for the equity market. But for that to continue, we really need to see that as inflation expectations continue to remain sticky, that still gives the Fed a little more room not to overdo it. And we see Fed communication continue. These are all the things we want to persist. And that persistence and consistency is what's going to make us feel better and more encouraged about equity investing.
Let's build on that. Today at 10 a.m., we're going to hear from Fed Chair Jay Powell. I misspoke earlier. We are not going to be hearing at 9 a.m. that sneak peek. We were going to get it released at 10 a.m. And I'm wondering if there is anything that he could say that would make you really rethink your more positive tilt. Is there something in particular that you're looking to understand more directly that you don't have a full handle on yet?
I would say consensus-wise, you've heard a lot about the 6%. Suddenly the sentiment on Fed funds and where they could go with the terminal rate. If Chairman Powell comes out and says something overly aggressive, which we think is unlikely, but potentially something could be interpreted as confirming that 6%. I think that could be quite shocking to the equity markets. That's unlikely, but again, something that we consider if we're talking about tail risks. On the other hand, if Chairman Powell comes out quite dovish, that could also encourage the market to flip back towards retreating yields, or if we see again at the end of this week the labor market signs, or if we see next week's CPI print, all these together are showing a mixed message rather than a coherent and same direction message. I think these are the things that the market is going to have to reprice and churn a bit for.
It's not a bear market. That's the call from Wells Fargo and the team, including Anna Hand. Anna, thanks for that, as always. We mentioned it in the last couple of days, last couple of weeks. We've had 2 years and 2 months. January and February, radically different. Of course, the change that we saw in February was off the back of the payrolls data, then CPI, then retail sales, then all of the above. And Tom, we're going to get another sneak peek of February now in the March data that gets released.
And what's important here is adults, like I think Torsten Slok at Apollo writing daily and in the morning, he comes out with the Goldilocks 3 scenarios now. I'm not saying he's optimistic, but he's looking at hard, soft, or no landing. I can't remember a time where adults like Anna Hahn in math and physics, or Torsten Slok with all of his great skills, are so narrative driven. We're making jokes about Goldilocks, but I don't remember this in the past.
If you take a look at some of the reports recently that have come out about quantitative trading and how much that's taken over, and how you're seeing individual bond and stock traders kind of pull back, stock traders in particular, people are saying perhaps that trend following momentum type of strategy is kind of driving the narrative more than anything else.
Marco of JP Morgan, Marco Kalanovic, spoke to some of this. He said this yesterday: while the day-to-day interplay of investors, speculators, the options market, systematic investors, etc., can produce strong rallies, we maintain their view. The risk assets are in a bear market and will not bottom until central banks start cutting rates. Get a Mike Wilson view on this over at Morgan Stanley in about 50 minutes from now. Looking forward to that as we count you down to testimony from Chairman Powell in front of the Senate Banking Committee at 10 a.m. Eastern Time. Futures positive, a little more than 0.1%. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. President Biden will propose raising taxes on wealthy Americans to help avert a Medicare funding crisis. His plan would boost Medicare taxes from 3.8% to 5% on certain kinds of income above $400,000. Now, it also would allow the government new power to negotiate drug prices for Medicare. Bloomberg has learned that more job cuts are on the way at Meta Platforms. The parent of Facebook will cut thousands of employees as soon as this week. Now, that follows a 13% reduction in November. Meta has seen a slowdown in advertising revenue and has shifted focus to a virtual reality platform called the Metaverse. China is shaking up oversight of its technology sector in the wake of a tech battle with the U.S. A national bureau will now manage and police data resources while building up China's digital planning. Meanwhile, the Ministry of Science and Technology will be strengthened to formulate strategic policies and orchestrate nationwide initiatives. Bloomberg's learned that Deutsche Bahn has selected Goldman Sachs and Morgan Stanley to advise on the sale of its DB Schenker logistics unit. A sale could fetch up to $21 billion. The German railroad operator is trying to slash debt and modernize its domestic operations. The Justice Department is expected to file an antitrust lawsuit this week to stop JetBlue's $3.8 billion takeover of Spirit Airlines. That suit is likely to claim that the takeover would harm flyers by leading to fewer choices and higher fares. Meanwhile, the Department of Transportation will try to block the transfer of Spirit's airline operating certificate. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
multi-trillion-dollar industry. There's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Our studios in New York and San Francisco. Our new hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech at a new time, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, starting Monday, March 13th, only on Bloomberg. Today, Fed Chair Jay Powell testifies before Congress. First, at 10 a.m., Powell appears before the Senate Committee on Banking, Housing, and Urban Affairs. Then, tomorrow, he goes before the House Financial Services Committee. How high will rates go and for how long? Are the Fed's aggressive hikes prioritizing unemployment over workers? Are Republican threats of default justified? Tune in to Bloomberg Television and Radio each day for live coverage. Bloomberg, your global business authority.
There has been quite a hawkish tone coming from the Federal Reserve. We'll hear a little bit more about that in due time. And, of course, from the ECB as well. One of the things about changing the target is it's a challenge when you change the target when you're below it. It's also probably a bigger challenge when you change the target when you're above it.
Catherine Mann there of the Bank of England MPC, the Monetary Policy Committee member, catching up with Bloomberg's Francine Lacroix a little bit early this morning. Fantastic conversation, Tom. We've known Catherine Mann a long, long time, from Citi back to the days of the OECD, and TK even further back than that. It's been amazing to see her transform into a real hawk on the MPC at the Bank of England.
People that know Dr. Mann are no surprise to that, the rigor from Massachusetts Institute of Technology. What's great about Kathy Mann is, John, to be excellent in one world scope of economics, like trade is one thing. She owns a high ground on 2 points. One is the trade, or classic book, is the trade deficit sustainable, which was hugely influential at the time. But the other, which is hugely timely, and she can't comment on it, is she is the expert on the codependency of America with China. This is something she and Michael Rosenberg minted, and she can't talk about that because of the position she's in.
You mean she can't talk about TikTok now?
Yeah,
like that, wouldn't we?
Well, you know, she can't talk about all of it. Catherine Mann of the Bank of England. Maybe we'll get to see her the next time we're in.
Very cool.
Francine Lacroix killing that here this morning. Right now, our chief Washington correspondent, Amory Horton, joins us. Amory, it's real simple. Republican, Democrat, everybody inside the Beltway knows there's only one relationship. Interest rates go up. The interest on our debt goes up as well. The wonderful Peter G. Peterson Foundation codifying this for us in February. How grim is it? Rates are up. How bad is the interest that we pay on our debt?
Well, a lot of people are complaining, obviously, if they're buying a new home and their interest on their mortgages and their house. I mean, this will become front and center today, obviously, as Powell's going to testify ahead of the Senate Banking Committee, and then, of course, tomorrow at the House. There's going to be a lot of, the lawmakers will try to politicize everything he says, right? So whether or not it's rates, about employment, about inflation, potentially about his number 2 pick that we're waiting for the Biden administration to announce. This is going to be a moment where likely Powell's going to have to also say, I'm waiting to see more of the data. But it's going to be a difficult one for him, but maybe not as difficult at his last appearance. That was June of 2022, and inflation was almost at 9%. So this potentially may be a little bit of an easier one for him.
But net interests are going to rise. CBO, I mean, has got out 10 articles that talk about the mathematics behind the politics of the budget as well. Is anybody down there actually reading what the CBO is putting out?
I think a lot of lawmakers are reading what the CBO is putting out. I mean, we're going to hear what the president has to say about his budget on Thursday. But already you have behind the scenes everyone working on the budget for the next fiscal year. But let's see what Powell has to say. But Tom, all of this is getting politicized, right? Of course, the Fed decisions and whether or not you're on the Republican side or the Democratic side.
This is the Senate Banking Committee. I want to talk about the Senate Intelligence Committee, the chairman, Mark Warner, who's set to unveil a bill today that the administration may well support, and it involves TikTok. They may not name it directly. Anne-Marie, what's going to be in that bill?
Yeah, just another TikTok bill. There's a slew of them, but this one is interesting because it does look like the White House may throw its support behind it. What this would do is really extend this executive order under the Trump administration that gives more of this leeway to the Commerce Department to go after some of these technologies. So this would really put it in the hands of the Commerce Department, while the one that got through, Jonathan, the other bill through the House Foreign Affairs Committee, shepherded through by Mr. McCall of Texas, that one would allow the president to ban it outright. But notably, this does not name TikTok by name, but a lot of these bills don't name TikTok by name, but it gives either the president, the Commerce Department, this authority to go after TikTok. But under the surface, we have to remember, TikTok right now is in negotiations with CFIUS. It is looking into this with the U.S. government, and TikTok is really racing against the clock to try to prove and come up with this plan called Project Texas that they can isolate U.S. user data and make sure it is safe, because they want to maintain in America and continue to operate in this country.
We talk about trying to create some sort of middle ground among the two polarized Americas, but I wonder, not just with respect to Republicans and Democrats, but within the Democratic Party as well, how much is perhaps some of the unity around issues surrounding China masking some of the increasing fissures, particularly for President Biden when it comes to the crime bill in Washington, D.C., and some of his social policies of late?
Well, so the crime bill has been a lot of pushback, right? Because Biden said that basically he's going to side with the Republicans. And in D.C. at the moment, you have the D.C. Council actually try to withdraw the crime bill. They don't want it to come to a vote to a Senate. So this has gotten messy. And there are some Democratic issues that have gotten messy for the president and infighting. But you make a good point, Lisa, whether or not you're in the Democratic Party, you're in the Republican Party, China is this constant thread in Washington that just absolutely unites the forces within parties and also across aisles. This is something where everyone seems to agree that more needs to be done. But clearly, the Biden administration at the G20 in Bali was trying to put this floor and, quote, guardrails on the relationship. And what did we hear from the foreign minister today, who's very well known? Qin Gang is very well known in Washington, D.C., because he was the former ambassador. And he's really explicitly taking aim at the U.S., saying that what they are trying to do is encroach on China and make this relationship worse. So this is going to become much more difficult for the White House to deal with as they try to put guardrails on China while they're being really pushed to a hawkish stance from Congress.
It's especially difficult when, if they ban TikTok, you enrage an entire generation of Americans. I mean, I wonder, realistically, could they ban TikTok if basically the children in their home and potential voters are like, we just want to dance? I mean, honestly, I just wonder how much that will play to a tone-deaf kind of audience, even if it sounds good on paper and if it's justified by some of the data concerns.
It's a great question. When you talk to lawmakers about TikTok, I mean, Secretary of Commerce Gina Raimondo recently talked about this. If they have access to anyone under 30, they know that this could potentially be a very difficult decision, especially as you gear up for 2024 and you try to want to embrace the youth to come out and vote for you. It's potentially why politicians and the U.S. government may end up striking a deal with TikTok that's going to partner with Oracle to make sure they can isolate some of this data. But I think if you have a child at home that uses TikTok, you're not liked at home if maybe you're liked in Washington, D.C.
MH, thank you. I mean, what a ridiculous moment. That right there describes the difference between an authoritarian country like China, who couldn't care less because there is no vote, and the US, a democracy that is worried about real intelligence risk around a social media company, but at the same time is worried about the youth turnout. What? I mean, that is bizarre. That is beyond ridiculous. If you truly believe it's an intelligence threat, then the fact that 20-year-olds might not come out and vote should not be part of the question at all.
You could just see the sort of modern day version of Footloose, right? You know, we just want to dance. We want to do our TikTok dances, you know, and you're just going to try to shut it down. But you've never seen...
Never mind, Bramo, carry on.
You're going to do that to me. No, it's a good point, right? I mean, how do you sort of bridge what's been accepted norm in our society at this point? And entire social structures have been kind of built up around this. How do you then say, get it out?
And that's before we get to the issue of reciprocity. You know, could US tech firms get the same access to the mainland? I'm sure many of them would like to.
I would guess that some of the other social media companies would be very happy if the US
You've
were
seen
to
the
ban
rally and
TikTok.
snap?
Yeah, exactly.
The last couple of days, yeah. You mentioned crime in D.C. You've seen the carjacking problem in Washington, D.C.
And this is what the crime bill was trying to target.
Amazing.
Yeah.
It's been climbing for 5 straight years.
Have you seen the pushback from some of the Democrats because they feel blindsided by President Biden potentially joining with the GOP?
Yeah, what are they pushing back against?
Just that there wasn't necessarily visibility. It's an interesting kind of fissure. That's what we were talking about.
I agree. The future's just about unchanged. Vichy Tirupatur of Morgan Stanley, up next.
or the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Three days of gains on the S&P 500. Can we make it for the fate of today's price action? Maybe in the hands of Chairman Powell in front of the Senate Banking Committee a little bit later. That's called a tease, Tom. Bit of a promo for Chairman Powell later. Whenever we do this, though, whenever we set the stage for the Fed chairman down on Capitol Hill in front of the Senate Banking Committee, it's sometimes a bit of a dud, isn't it?
Sometimes.
Who writes the senators and the representatives' questions? They don't come up with
I'm sure they've got a decent team behind them. Some of the questions, you kind of sit back and you're like, oh, that was actually quite smart. I wonder who wrote that.
Well, yeah, the ones that actually get into the weeds a little bit, they're probably not analyzing monetary policy.
You've got a friend on Wall Street. I know where that's coming from.
100%.
Equity futures up 0.2 on the Nasdaq too. Let's just whip through the bond market as well. 2s, 10s, and 30s shaping up as follows. Your 2-year just backing away again from where we were last week. Through 490, we're at 487 at the moment. Through 4% last week on a 10-year, 390, 382 right now. Yields down a couple of basis points as well. I promised you some ECB speak.
Oh, please.
So we had one ECB official from the Austrian Central Bank, the governor there, Holzmann, is talking up 450 basis point hikes. So another 200 basis points of tightening at the ECB. Now, yes, he is the biggest hawk on the ECB, but the fact there is someone willing to go into the governing council meeting maybe later on this month, Tom, and make that argument just tells you where some of the committee's at and what the debate might sound like.
I totally agree, and I'd also agree that the screen right now, the Bloomberg terminal, is very deceptive because, John, you mentioned here, yields are churning a little bit, and yes, they're a little bit lower, and maybe the curve is doing this thing, but the fact is the vanilla 2s10 spread is breaking out to new greater inversion. We're not quite there, within a little bit of a stinch going back 2 days, and the broader 3-month 30-year piece is now back under a full 1 percentage point difference between 3-month paper and 30-year paper. So there's some tension in the data check today that's maybe not that evident.
It might be quieter today, but that tension was evident yesterday. We had a 10 basis point move at the front end in Germany off the back of those ECB comments. At least I have to say, for me at least, what I'm paying attention to, they talk about dropping forward guidance, but then they offer pretty firm guidance for the next meeting. They're saying we're probably going to go 50 at this one. It's whether they do the same again coming out of the March meeting, and based on what we're hearing so far, there might be a good chance of that.
And what they say about the balance sheet as well, whether they start to actually unwind and sell off some of what they've accumulated on their balance sheet. Let's take a look at some of the stocks that are moving ahead of the open. Dick's Sporting Goods shares are popping after reporting earnings that were better than expected, seeing the adjusted earnings per share for the upcoming year of $12.90 to $13.80 versus an estimate of just $12 basically and 3 cents. Basically, same store sales up about 5%. Wonderful results across the board. Those shares up 4.3%. Just the tale of the haves and the have-nots within the retailing sector. I'm not surprised that people who buy cleats and bats and things like that for their children might actually end up fueling the sales here, just, theoretically. And we're also looking at Meta. Those shares up 1 point.
Have we got a child playing baseball? Is that it just sounds like someone was deeply disappointed with how much things cost over the weekend.
Whether it's the baseball bat, bags.
How much is the bag
whether
now?
it's- The bag can cost anywhere from, if you get a good one, it can cost over $100.
No.
And then, the cleats, and then, with batting gloves.
Do they
and then
last,
things.
though?
Well, it depends if,
Lisa?
you believe in the pop hole theory and all
I've
that
got two
stuff
words for
and all
you.
that stuff, yeah.
Ice hockey.
Yeah. Oh, that's, I'm sure, such a
Real money.
cheap. Yeah. Maybe just carding.
My football boots used to last me a season. I'd
Yeah?
get through a season with one pair, yeah.
What about shin guards, your socks?
I'd
there are
hold
other
on to
things.
them, but yeah, but I played for a team, so we got given all the
Oh, so there you go.
jerseys.
Does your offspring have the bag with the bat with like the 8 bats in it?
I don't want to
Because he
talk about it.
doesn't know which-
Let's move on to Meta. Meta is doing more layoffs, which is really interesting in light of November, 13% of the workforce. That was the announced cut back then. And at the time, Mark Zuckerberg said this was the last of it. Now we're hearing that there are thousands more being cut. Those shares up 1.3%. And Rivian, this is fascinating. We talk about Tesla and their dominance over the EV market. Rivian shares are down more than 7% because they're offering $1.3 billion of green convertible bonds, basically that could potentially dilute the shares. But the bigger point to me is that they're raising more capital to plug the fact that they're burning through cash as they try to
I
compete
wanna
with some of the
come
other
back to
behemoths.
this. We can't do this right now. I think it's brilliant, Lisa, and we can't do it right now. We got to get to Vishy, but I'm sorry. I think this whole EV thing needs a lot more chat. I just, I'm a complete amateur on it, but I think you're dead on to feature Rivian there. He is a chief fixed income strategist at Morgan Stanley. Vishy Terapatur joins us right now, synthesizing in all of that historic fixed income platform. Vishy, I love what you say because we're feeling it every day here at Bloomberg Surveillance. It is a data haze. There's no question about it. Where out there is the clarity you write of?
There is really a data haze. Is conflicting signals. On the one hand, we've had the inverted yield curve that you referred to just now. That's giving it a different signal. The PMI new orders gave a different signal, and the signal of weakness. The leading economic indicators on the conference board similarly. But on the other hand, we had a gangbusters payroll number. We had very strong retail sales. So we've had very conflicting data. So this is I think that this week and the next week are going to be important weeks for getting some sense of where is this data,
Right.
what is the data, what are the data telling us?
On a blended basis, can you use the new ample coupon to protect yourself if we get further price down, yield up?
In fact, that is the case. What we are recommending to our clients is, neutral duration. So it doesn't feel like a move of, say, 25 to 50 basis points on either side of the can happen this week and next week. So we are basically saying until we have greater clarity on the trajectory of economic growth, are we heading for towards a soft landing, which is what our base case of our economist says, or this construct of no landing, which we're not big fans of. I think we need to have until we get some clarity, we will be neutral on duration, neutral on dollar, and stay very high quality and much lower duration on the front end.
Vishy, that's interesting. Given everything we've priced over the last month or so, now a terminal rate priced at something like 540, you still think the risks around the bond market are that balanced?
I think at this week and then perhaps or next week, I think there is risks are really that balanced. I think that there is if we the data from January, the payroll data especially, was affected by a number of things. It was affected most importantly by seasonality factor adjustments and by the weather. The seasonality factor adjustments will not help the February numbers as much. On the other hand, we also had a relatively warm February. So, putting those two things, it is pretty conflicting. So we would really our base case expectation is a below consensus expectations from our economics team, below consensus expectation from payrolls. But given the wide range of outcomes that we have seen over the last several, at least in the recent past, whether we end up in a downward trending, labor market, employment, non-farm payrolls towards a downtrend, or was January not a blip? That's, the outcome of either of those outcomes can be mean very differently for the bond market.
Let's talk about what the potential market responses would be to either of those outcomes. If we get a hotter than expected print on Friday, what does that do in terms of your expectation of how high rates could go? And then on the flip side, how much could the market retrace some of the hawkishness they've priced in?
I think in either way, in either case, at least 25, depending on the extent of the surprise, it could be even bigger than that. That kind of a move is what we would expect to see. If we have a 350 type of number for non-farm payrolls, that could significantly bring the probability of a 50 basis point hike, higher up in the, it will increase the odds of a 50 basis point hike in March. Not our base case. But I think it's I think we'll hear Chairman Powell reiterate that the data dependency of decision making, and as he speaks today, he would not have the knowledge of the employment the Friday's employment report coming in, so he would be in the same level of uncertainty about data as we are all.
Vishy, before we let you go, I'd love your thoughts on what happens with Bank of Japan on Friday. How much does that matter for the U.S. bond market? We were talking about this with Alan Ruskin of Deutsche Bank, and he said it might not have that big of an impact on longer-term U.S. yields. Do you agree?
In terms of, I think that my personal expectation is on the 9th, we will not see a change in yield curve control. It would be. I think our expectation is over the course of the year we will see changes to yield curve control, not on March 9th. And if there is whenever yield curve control goes away or we move towards a higher part of the JGB rates, the effect is not directly so much on the U.S. rates itself, but I think it will be the incremental demand for the spread product. I think the incremental demand for spread product, be it credit, be it securitized products or MBS, those spread products hedged into yen terms would not look nearly as attractive as they do today, or that they did some time ago. So it's not the direct effect on the rates themselves, but really I am or would be concerned about what it means for incremental demand for all these other products, not so much directly the treasuries themselves.
Vishy, always great to catch up with you, sir, to get your view on this fixed income market. Vishy Tripatur there of Morgan Stanley, the chief fixed income strategist over at MS. A little bit later today, 10 a.m. Eastern time, you will hear from Chairman Powell in front of the Senate Banking Committee. If you are just tuning in, you'll hear from him again tomorrow in front of the House Financial Services Committee. Sometimes, Tom, the tone and the questions are different in that one on the Wednesday compared to the Tuesday.
They are, and they're both of value. I think it's really important
That's kind of
Humphrey Hawkins was invented to give more communication in a time of dramatically less communication. I don't think it's nearly as important as it was 20 years ago because these people just speak nonstop. I mean, do we have Feds? We don't have Fed speakers today. Are they in quiet period now?
No, not quiet period until Saturday.
Till Saturday.
So end of the week.
How the hell do you know that? You're just a font of wisdom.
Because the meeting's on the 22nd. So it's usually the whole week before is clear. And then...
What about Sundays? They can talk on Sundays.
They can talk on Sundays.
Yeah.
Just, God.
News you need to know.
They can't talk. You won't hear from them again after Friday.
Do you know I'm on an airplane for the Saudi Arabian Formula One?
What's that?
I may have to cancel my trip.
Oh, right. Who are you flying with?
I'm flying with United.
To Jeddah?
No, Francine is the Gulfstream, so I'm flying United.
In 2 weeks?
2 weeks.
What kind of wheels do they use? No, I'm kidding.
No,
United plane.
You.
Let's move on.
They're Pirelli, but I don't know if they're... It makes a difference,
very expensive.
right?
Oh, yeah. Oh, yeah.
They want to be on soft wheels, right?
Tire deck. Well, it depends what kind of track it is and what your strategy is.
And then in rain, they have grooves like we have.
Yes. Yeah. Wets.
See, I'm learning.
You can have wets. You can have intermediates, and then you can have full wets. Yeah.
Wets. Okay, yeah. I'm learning.
That's good. Welcome to the show.
The Rambler has chains. That's all I know.
Futures up for 10. This is Bloomberg.
Always learning something new. Keeping you up to date with news from around the world with the first word. I'm Lisa Mateo. Well, the job cuts aren't over at Facebook parent Meta Platforms. Bloomberg's learned the company is planning a new round of layoffs and will cut thousands of employees as soon as this week. In November, Meta eliminated 11,000 jobs. That's 13% of its workforce. Taiwan's President Tsai Ing-wen reportedly persuaded House Speaker Kevin McCarthy to meet in the U.S. due to security concerns. According to Financial Times, Tsai's government shared intelligence with McCarthy about threats posed by China. McCarthy has said he wanted to visit Taiwan at some point. The powerful sister of North Korean leader Kim Jong-un has issued a new warning to the U.S. and South Korea. Kim Yo-jong is threatening severe consequences if the two countries go ahead with joint military drills next week. Last month, North Korea threatened to turn the Pacific Ocean into a firing range if the exercises took place. Consumer expectations for Eurozone inflation have receded significantly. That's according to the European Central Bank's monthly survey. Expectations for 3 years ahead plunged to 2.5% in January from 3% in December. The pullback comes just over a week before ECB policymakers are due to set interest rates. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
So what is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO, so buy high, sell low. You know, and the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
The moment news breaks, no one covers the world like Bloomberg.
6 people have died from these latest quakes, adding to the 41,000 plus people who've died in those major quakes 2 weeks ago.
A top Sam Bankman-Fried associate said to be nearing a plea deal.
How does that help build the case for the prosecutors against Sam Bankman-Fried?
Biden is here to say we will stay with Ukraine until the very end, and that's really a show of support as well for the allies.
Bloomberg, your global business authority.
From New York City,
From London and Sydney.
from Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
Why do the biggest names in business choose Bloomberg?
That is a great question.
Great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
What the story is of 2022 as well, where we started to see unusual market conditions, currency changes. We also started to see inflation. That is when all of a sudden 2022 was not like 2021, and the surge of employment and all the things we did to invest for 2022 that never really showed up. We have made changes to our company to reflect current market conditions.
Just very cool to hear from Mark Benioff, the Salesforce chairman and CEO, in the last week. Trying to look forward to a better year, that's for sure, over at Salesforce. This is what Meta's looking forward to potentially. We're reporting they're planning a fresh round of layoffs as early as this week, according to people familiar with the matter. This coming on top of a 13% workforce reduction in November. The CEO, Mark Zuckerberg, saying at the time, I view layoffs as a last resort, so we decided to rein in other sources of cost before letting teammates go. Overall, this will add up to a meaningful cultural shift in how we operate. We'll roll out more cost-cutting measures like this in the coming months. And Tom, the coming months might mean this week we do it again, just a little bit more.
I think the reality here is to look at the history of it with all of these companies, including the miracle that I believe Apple didn't overhire. John, I'm stunned by this. Meta, number of employees pre-pandemic, 45,000, and now 86,000. I did not know that.
I'll do the same with Amazon. It was something like 800,000 into the pandemic and more than 1.5 million coming out the other side.
I think Amazon we get like it's the last mile, it's warehouses, it's trucks on, you know, whatever street. But with Meta, I mean, what are they doing at Meta? They're all in offices or work from home, doing what Meta does, Instagram and, you know, Facebook and I had no idea they went from 45,000 to 86,000.
Demand just went through the roof across the board at these firms.
Let's get a brief on that right now. And you know who we turn to, Mandeep Singh, Senior Technology Analyst at Bloomberg Intelligence. An amateur like me, Mandeep, looks at 45,000 out to 86,000 and go, duh, they overhired. Did they overhire?
Well, they probably did in hindsight. And I think what they saw was revenue accelerated. You know, they doubled their revenue in this time period. So typically the way tech companies go about it is if revenue growth is, you know, let's say 25, 30%, they will expand their employee growth in line with revenue growth. And that's what Meta and a lot of other tech companies end up doing. The timing of this cut, given it's coming, you know, just after a few months of the last cut, suggests that they are probably not seeing the end of this downturn, especially in terms of top line acceleration. Right. And I think that's where you could question how much is the metaverse pivot responsible for it, because metaverse right now, the Reality Lab segment, it's like 2% of their revenue, but it's 20% of their employee base. So that's something to keep in mind.
What I think is so important here is a broad look at technology. Is the digital ad growth party over? I mean, there was just an assumption there would be digital ad growth forever, forever, forever. Is that really what we're talking about here? Is it's finally done?
No, I think it still is cyclical. And the reason I say that is right now, when you look at the advertisers, it's mostly e-commerce, gaming. These type of advertisers have pulled back a lot because they're seeing slowdown in their core businesses. You compare that to travel advertisers or financial services, they're still aggressively spending on ads. And look, when it comes to digital ads, they are definitely more targeted than your linear TV ads. So I do think, you know, given we are talking about ChatGPT and large language models, it's going to make those ads more targeted over time. So that secular trend will remain. The question is, who has the engagement? Because at the end of the day, you're going to show ads at places where people are engaging. And those platforms, whether it's Meta or something else, that's what needs to be figured out here.
Or TikTok. And I wonder if that engagement at TikTok gets sort of segmented off by the U.S. government. Who benefits the most? Is it Meta?
I think it's going to be all of the digital platforms, Meta, probably more on the Instagram side, but YouTube, we think that is one of the biggest beneficiaries simply because YouTube has the scale, 2 billion monthly active users. And now a lot of the streaming, when it comes to, you know, your core cable TV channels are being viewed on YouTube. And that is quite powerful because when you layer targeted advertising on that platform, which is basically showing different ads for different types of demographics, that's quite powerful. And I think a lot of that secular shift in ad spending to digital platforms will happen on streaming.
Before I let you go, Mandeep, we started talking about the layoffs at Meta and how Facebook is doing another round of cuts potentially this week on top of what they did back in November. How far are we from seeing the end of tech job cuts?
Well, this in particular suggests the fact that Meta, which is 85% of social media time spent, doing another round of layoffs suggests we are probably not seeing the light at the end of tunnel here. And it's probably got some more room in terms of this downturn. And the top line acceleration is probably a 2024 thing at this point of time.
Given how difficult it was to hire, Mandeep, are some tech firms taking a different approach and just saying, okay, we made a mistake, let's try and grow into it over the next few years?
So you could say that for software companies that have a recurring subscription model. I think it's harder for ad companies, which are more transactional and, you know, their ad pricing is determined through an auction. So clearly, it'll be harder for them to have a control on their top line. But for companies that have a recurring model, this is the time where they think, you know, they can get more talent as well as make sure their morale stays high, and they're going to come out stronger if they show cost discipline.
I was also thinking about Amazon as well, Mandeep, a company you and I have talked about before. Tom and I mentioned it. They basically doubled the workforce through the pandemic, and they've come out with very minimal, marginal cuts to the headcount. Why do you think that is?
Well, because one thing is when you look at the last mile delivery or all the things they're trying to build around the e-commerce side, these are secular trends. It's not as if, you know, the world is going back to the pre-pandemic ways, and a lot of the change in behavior is going to stick. The question is, when will there be a rebound in terms of growth? And that's why I think if they have the scale and they continue to operate with, you know, cost cutting, they will be at a point where the scale player eventually kind of wins on the internet side. And I think that's where Amazon definitely has an advantage.
Hey, Mandeep, wonderful to get your thoughts. As always, Mandeep Singh there of Bloomberg Intelligence. Meta almost flat over the last 12 months now, because year to date, it's up 54%. Yeah. It's absolutely,
I nailed it.
Absolutely flying, Tom.
We did not have that in the triple leverage all cash GDP.
But you get 5% on T-bills now, Tom. You should be happy with that.
Yeah, I don't know what to make of this, and I respect immensely where Mandeep says it's not about a digital ad slowdown, but I'm just, you know, coming out of the pandemic, what's the new digital look like? What's the new? And I don't mean just Meta. I mean the whole complex of huge revenue growth dominant West Coast companies.
I mentioned 5% on T-bills, Lisa. Finally, hello, CDs. They're starting to offer some interest now over at the banks.
I think more than a dozen banks are starting to offer about 5% on CDs, but it isn't the major ones. And this is what I find interesting.
So it's dragged, kicking and screaming.
Basically, the major banks are saying we have plenty of deposits. We don't need to attract them. So if you're, you know, Capital One, go ahead. You can offer a 5% CD, but you're not going to compete with us. And then maybe around the edges, they have to start pushing up their rates too. And that's what you're seeing. It's incredible competition.
The toasters are coming back, Tom. You hear about that? Toasters are making a comeback. You've been waiting for this for 10 years. Free toasters. That's all he's waited for.
Yeah, he hasn't even bought a toaster.
Just wants the competition.
Yeah.
Marcus.
So the toasters return.
Here we are. Good morning, Mr. Solomon. Marcus, 3.75% APY. It's 4 times the national average. You know, no fees, no minimum in that, but it's that game. They're slow to raise rates, aren't they? They're just like, you know.
A lot of these banks have so many deposits. I mean, the Bank of America, JP Morgan, and they were actually talking about how they didn't want so many deposits because it became a liability for them. So, you know, until we see them actually start to lose deposits at a fast enough pace, they may not raise rates as much as other banks, at least on their CDs, et cetera. But here's the issue that I'm wondering about. When do people start to realize they are losing a ton of money that they could otherwise get in just flat cash in the bank account? I mean, there is this inertial force. I mean, it's just the extra paperwork and having to deal with it. Like, isn't it going to right size anyway? I mean, there are people who think like that.
Yeah, are you describing yourself?
Just theoretically.
Talk about this every day. You're explaining to our audience you're sitting at 0% right now, Lisa. Is that where you're going with this?
Move on.
Move on for you.
I talked to our people yesterday outside the prospectus as we write for the ETF, and John, the simple answer is if we get 6% 3-month LIBOR, we get a 2 and 20 payout on the triple leveraged all cash fund. You know, we actually get finally back to.
We get bonuses.
Well, you guys are on the board of directors.
No, Vetbill was on my seat.
You're on the board of directors. It's good. So is Vetbill.
I hope Mike Wilson's not listened to this because I want him to stick around. From Morgan Stanley, the chief equity strategist, is going to join us in just a moment. We'll catch up with him as he acknowledges maybe you can get a pickup.
This is important
in this market.
For global Wall Street. This is important.
He said equity survived a crucial test of support. That suggests this bear market rally is not ready to end just yet. Mike Wilson up next.
Just to add to my anxiety levels, which are already through the roof, I want to talk about the social consequences of this, because it seems like an environment where inflation is high, growth is slowing, you know, the Fed is explicitly trying to boost unemployment. Like, it seems like that is probably the worst environment for, you know, your average person on the street. And it almost seems like the Fed's goals here, they're almost anti-American at this point, or like anti the American dream, right? Like housing more expensive,
crushing the housing market,
crushing demand, crushing labor force. Like, what are going to be the social consequences of central banks, you know, having to do this in order to put a cap on price increases?
They're going to be severe. You know, we're already seeing, of course, a backlash against free market, backlash against trade and globalization, even a backlash against technology, a backlash against, you know, laissez-faire policies, because there has been a massive increase in income and wealth inequality. This is leading to populism of the extreme right and or of extreme left in many countries across the world. and authoritarian regimes becoming more popular across the board. It's a repeat of the 30s, literally.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
I think inflation is complicated when it comes to the U.S. equity market outlook.
It's hard to feel confident you're going to get inflation all the way back down to the 2% target that you see.
We're still in this kind of slower climb up.
The Fed can get inflation to wherever they want it to be. They can get growth to wherever they want it to be. The question is what needs to happen to rates.
Right now, the market's putting about a 30% chance that the Fed will go 50 basis points at the March meeting. It wouldn't take much to push that over 50%.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television. A must half hour here for Global Wall Street. Michael Wilson of Morgan Stanley will join us in a moment. And within the data haze that we heard earlier from his colleague Vishya Patel, John, it is a data haze going to the chairman's discussion this morning.
One question for Chairman Powell. Will he validate market pricing? We're now looking at a terminal rate, Tom, of 540. Will he give that the official seal of approval going into payrolls on Friday and CPI next week? It's going to be difficult for him, TK, because the narrative switched so quickly after that payrolls report for the month of January that we got in early February after their last meeting. He sat there in that news conference and said the disinflationary process has started. Will you repeat that phrase a little bit later in front of the Senate Banking Committee?
You go to the physics of it, which is he going to be so brave as to say that? I don't understand how he can do that. Not only the headline data coming out, but all the minor data as well really adds into it.
Well, I think Vishy really phrased it well. The two-way risk around the data this week and next week, Tom. Yeah. Payrolls Friday, CPI on the 14th. There's a lot of two-way risk. You either get confirmation of that buoyancy, that strength of the January data, or you don't. Right. And we flip aggressively the other way, Tom, pretty quickly.
1991, the Dow Jones Industrial Average, 2,900. Now it's at 33,000. I know, John, that you need to know that to get a benchmark here. Lisa, the great Jules Westheimer of Wall Street Week. Mike Wilson was a little kid at home with his popcorn in his hand on Friday evening, watching Louis Rukeyser and Jules Westheimer. And Mr. Westheimer said, gloom rules on Wall Street. I mean, that's really where we are until we don't, like Anna Hahn or like Mike Wilson.
I disagree. I think that gloom isn't ruling at all. I think that right now there's an optimism that's been ruling at least since the beginning of the year. And now there's this feeling that perhaps the U.S. can get past 5.5% rates, 5.4% rates for a year without seeing some sort of major recession. I mean, how many people are just full on, just deeply unapologetically bearish right now?
For all of you on radio and television, stop what you're doing and extended conversation here with Michael Wilson. We got to do the data first, John. Sure. I'm looking at curve inversion that won't go away, negative 93 basis points on 2's 10 spread.
But yields have backed away from the levels of last week. The 10-year was 3.4% for the first time since November. We're now down another 2 basis points to 393.82. In the FX market, euro dollar negative 1/10% at 106.68. And in the equity market on the S&P 500, above 4K, and we're positive 1/10 or 0.2% on equity futures. There was just one quote yesterday that stood out for many of you at home, I know. It was from Mike Wilson and Morgan Stanley, and it read as follows. Equity markets survived a crucial test of support last week. That suggests this bear market rally, Tom, is not ready to end just yet. How much of a change was that from Mike and the team?
This is a pretty substantial change. We're going to dive into that right now with Mike Wilson. Mike, John wants to dive into this. I'm gonna talk right now. I got to make some news here, Mike Wilson. So help me out. The great Ralph Ancampora was on a while back, and he said, "Look, there was an October bottom." We've heard this from a few other select people. With this more optimistic call by you, can you call an October bottom? Can we call it the Ancampora-Wilson bottom?
Well, good morning, guys. Thanks for having me as usual. Well, we did call that bottom in October, and we thought it would, be a substantial rally, 15-20%. We got that rally, and then we decided, well, the risk reward is no longer attractive, and so we backed off of that, and we said we'd probably go down and retest those lows at a minimum and probably take it out, which is really based on our fundamental view that, the earnings recession is now in place. People acknowledge that, but I think there's a very wide range of how deep that earnings recession is going to be, with us kind of in the deeper end of that range. Now, this past weekend, we looked at the chart. But we have to be objective about what we see. We're technicians in addition to fundamental strategists, and we looked at the price action last week, and we actually talked about it in the note the week before. We said, look, we're going to probably test this level. If it holds, it'll be a constructive marker, at least in the short term. And that's how we're viewing it now, Tom. It's a short-term positive. I don't think it changes our intermediate-term view that, the risk-reward is still pretty lousy at 4,100 because of that earnings recession view that we have on the fundamental side. So we're remaining in a trader's market, and part of our job is to help people navigate that.
So, Mike, just to be clear, how different is this call compared to the call for the tactical rally you made back in October?
Oh, it's very different, John, because, in October we were trading 3,500. The valuations were 15-20% lower. Interest rates, were higher. We felt like they were going to come down. So we had a lot of catalysts. China, reopening. There were a lot of reasons to believe that was a very tradable low, not just for trader types, but for people who run real capital. And it turned out to be the case. So, we don't always get that stuff right. It's impossible to get it right every time. So this is much more tactical. This is just sort of saying, look, we acknowledge that the technical picture held. We didn't know that was going to be the case, and so you have to respect that. And hey, they could turn down this afternoon again, for all I know, given what Jay Powell's going to say in his testimony. I have no idea. Maybe that triggers people to get negative. One thing I will say to you all, however, is that we're pretty confident that between now and the next earnings season, which isn't that far away, that will be when we think the next, bear market kind of decline happens. Maybe like a more meaningful decline, 10% plus.
So, Mike, we can get further down the road in just a moment. I just want to sit on the early part of this year. It's difficult to get everything right. You put out a note early in the year and you said 3,900 was an easy sell. What's more difficult about it now besides the technical point that you've made?
Well, I think there's a couple things you have to acknowledge. I mean, the economic data has been better. China's reopening is kind of just getting going, and they've kind of held back. They could gather some steam. So those are things you have to say. Look, I mean, I think people came into this year feeling as if the recession was inevitable, and that no longer is the case. It's probably 30% chance, maybe 40% chance at best, and that can keep animal spirits alive. The other thing that's happened, John, is we've talked about multiple times, is this liquidity picture from outside the U.S. So the Fed's doing their job, trying to tighten financial conditions. The problem for them is that we have the Bank of Japan and we have the PBOC adding liquidity, and you have a dollar that's kind of softening up, which is kind of neutralizing, the Fed's goals of tightening financial conditions. And that's also kind of breathed some life into risk assets. So that's the only thing that's changed. Ultimately, we think, valuations and the fundamentals, meaning earnings, will determine where stock prices trade. That setup is not particularly great, particularly to move higher in rates this year.
Given some of the changes that you talked about just now, Mike, how much does that change what floor you could see in your bear scenario for equities?
Well, I mean, look, we have to be flexible. We're trying to, also service a lot of different types of clients, right? Whether we're talking about trader types or we're talking about asset owners. For the asset owner crowd, we've been pretty adamant. We felt like the fall was a really good entry point where people had a longer time horizon. And if you added risk there, you probably just stay with it. I do think people, though, are getting a bit carried away on what they've been buying. Okay, so I think they're, given the rally that we saw in the fall versus the rally we've seen this year, they have very different sort of complexions, right? The rally in the fall was based on, we think, fundamentals, meaning rates coming down, economic data getting better because of China, globally at least, and that would help the kind of cyclical type areas of the market. Then we had this more speculative rally that started in January, kind of buying last year's losers, which was all the growth stocks and the meme stocks, whatever you want to call them. And those have just gotten out of control again, particularly in the context of higher rates. So I think there's a lot going on, right? And I think there's two ways to think about it. If you have kind of, names that you want to own, through, you want to underwrite through what we think is going to be a difficult time for earnings, and you say, look, I think there's value in this security for the next 3 years, great. You should just own those through that period. However, there's a lot of stuff that's gotten dragged along here that is wildly speculative now, in my view. It's actually somewhat reckless. And that's the stuff that you got to be really careful. It's in your portfolio. You got to get it out of there because that stuff has gotten revalued in a way that doesn't make much sense to us.
What kind of downside could you be talking about? And I assume you're talking big tech names as well as some of the other meme stocks.
Well, for some of this stuff, I mean, I think there's plenty of stocks that are probably going to go bankrupt. I don't think that's a crazy statement, but that's not the bulk of the stock market. Okay, so this is a pocket of the stock market, and then I would say, but overall, like the growthier stuff and the thing that even the cyclical names that have gone too far now could have as much as 20% downside, no problem. I mean, our valuation work would suggest that even without the earnings recession, right, the valuations are kind of out of bounds again. So it's a stock picker's market. A lot of people are saying that. That's usually what people say, by the way, when they're having a hard time calling the direction of the market. We do it too. So everybody says, oh, it's a stock picking market. Well, that's hard. Okay, so that's not an easy game to play, but it is a stock picking market, and the stocks that are likely to go up versus down is probably less than 50%. It's a stock picking market with not a great, macro backdrop. So that's the challenge.
Mike, I always appreciate how you acknowledge
and talk about that.
How you acknowledge some of this and how difficult it is right now. Mike Wilson of Morgan Stanley is going to stick with us, and we will come back and talk about that conversation in just a moment, Tom.
I think it's just critical here to me. This is, Mike and I've been through this a million times. All of a sudden, with gravity returning, all of a sudden with interest rates we haven't seen in 16 years, it's not that the party's over. It's just we've returned to normal dynamics. And the key dynamic, and this is off my great mentor in England, Lord Desai, at London School of Economics. You know what matters? Profit, free cash flow. And there's a lot of people out there right now without profit, without free cash flow.
And this call from Mike is a big earnings call. Let's be clear about that, Lisa. This is about earnings. He does not think earnings are going to impress this year.
And we've already seen unimpressive earnings. Let's be really clear. We didn't see gangbuster results. We saw things that really disappointed more than usual in terms of the latest earnings season. So how bad did things have to be to kind of get us maybe in a different mindset on a market level, but we'll be picking stocks?
We'll continue this chat with Mike Wilson of Morgan Stanley, the Chief Equity Strategist, in just a moment. Just to give you the lineup of things, a little bit later this morning, 10 a.m. Eastern Time, you hear from Chairman Powell, confronting, facing off, grilled by. All those headlines are always the same, aren't they? By the Senate Banking Committee. And then it starts.
Several senators.
And then it starts, and it's just like, okay. How many hours of this? Yeah, okay. Yep. Looking forward to that. That starts at 10, and then, if that's not enough for you, he does it again in front of the House Financial Services Committee on Wednesday.
It usually ends 2.5 hours later. Nice. Usually lasts that long.
And so what do you make of the quality of the questions in the House on Wednesday?
I think it's a different quality. I think it's a stock picker kind of quality.
Very diplomatic.
I'm trying.
Your bond market yields in 2 basis points, 393. Futures up 2/10. This is Bloomberg.
Keeping you
you up to date with news from around the world with the first word. I'm Lisa Mateo. President Biden will propose raising taxes on wealthy Americans to help avert Medicare funding crisis. His plan would boost Medicare taxes from 3.8% to 5% on certain kinds of income above $400,000. It would also allow the government new power to negotiate drug prices for Medicare. Bloomberg has learned that more job cuts are on the way at Meta Platforms. The parent of Facebook will cut thousands of employees as soon as this week. And that follows a 13% reduction in November. Meta has seen a slowdown in advertising revenue and has shifted focus to a virtual reality platform called the Metaverse. China is shaking up oversight of its technology sector in the wake of a tech battle with the U.S. A national bureau will now manage and police data resources while building up China's digital planning. Meanwhile, the Ministry of Science and Technology will be strengthened to formulate strategic policies and orchestrate nationwide initiatives. In France, unions are hoping to bring the country to a standstill in a 6th day of protests. They're demonstrating against President Emmanuel Macron's plan to raise the minimum retirement age. Transportation is likely to be severely disrupted. Only 1 out of every 5 high-speed trains will be running. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Bloomberg brings you the latest from China's 14th Annual National People's Congress, including China's COVID recovery, economic outlook, and geopolitical tensions. Continuing coverage this week on Bloomberg. Today, Fed Chair Jay Powell testifies before Congress. First, at 10 a.m., Powell appears before the Senate Committee on Banking, Housing, and Urban Affairs. Then, tomorrow, he goes before the House Financial Services Committee. How high will rates go and for how long? Are the Fed's aggressive hikes prioritizing unemployment over workers? Are Republican threats of default justified? Tune in to Bloomberg Television and Radio each day for live coverage. Bloomberg, your global business authority.
We can still have a soft landing. A mild recession is possible. A harder recession is possible. I think there's a good chance that inflation will come down, but not enough by the fourth quarter. The Fed may actually have to do more. And I think a lot of things that happen in the world, think of the bigger trends, are inflationary.
Tom's favorite thing when CEOs of financial institutions start talking.
Oh, John knows after the third beverage I get going on.
I saw a load of headlines from comments from Brian Moynihan at Bank of America overnight. All these comments were coming through, and I was like, yeah, that's what Mike Gapin says of B of A.
100%.
Just read his research.
Yeah.
Not really news. But anyway,
I'm going to cut James Dimon some.
Oh yeah, I wasn't talking about Dimon.
Guy
I'm talking about
writes
BofA.
brilliant. He synthesizes in, John. I'm guessing 200 people help him write his annual letter. I'm just guessing out loud, and I wish other bankers did short or long, like Mr. Buffett from years ago or Mr. Dimon now. I find them valuable, and they touch on different tones and themes, and I wish it was more like that than, what do you think about Y equals C plus I plus G plus NX?
It really highlights the stock picker versus the macro, right? Everyone's a stock picker when macro gets too difficult, unless you're a CEO, and then you go macro because you don't have to say anything because nobody knows anything. But if you're a stock picker, if you're arranging your business, how do you end up making decisions if the macro is so uncertain?
Well, I think we're going to continue this conversation with Mike Wilson and Morgan Stanley in a moment. And what Mike's been great at, Tom, over the last few months is explaining that you could see a difference between the real economy and what develops in stocks. The earnings are different to what you might see overall in broader GDP.
Absolutely. I'm a huge believer that the linkages are suspect, to say the least, and the financial media likes to move it in lockstep. Let's get back to this conversation with Mike Wilson, hugely influential across all of global Wall Street. He's the chief U.S. equity strategist and CIO at Morgan Stanley. Mike, I want to go to what I think is the great divide. As Taleb says, the gravity has returned to the system. You remember this when you were...
Yeah, I mean, I have a metric, which is that, your costs sit on your balance sheet until they have to hit the income statement. And, this whole idea of accrual versus cash accounting, which we did learn, seems like 40 years, probably was 40 years ago. I have a history of studying accounting, and it's a great tool to kind of see through the noise. And this is why we, our note this past week, we highlighted a great report done by our global tax evaluation team, and basically highlighting this, spread between cash flow and net income that's being reported. That's all based on accruals. And so it ties into everything we've been talking about for the last year and a half, which is the pandemic, the lockdowns, basically brought on this incredible period of over-earning by corporations because their costs were slower to increase than the revenues came back. But now we have the exact opposite, which is that companies, basically accrued these costs on the balance sheet at a bad time when, inflation was running hot and they thought business was going to continue to be that strong. So they built for it does not actually happen now. And that has to flow through the income statement, and that will hurt margins. And that's the story. The question is, will the markets look through that and suggest, well, we know this is temporary. Ultimately, companies get their head around that, which we agree with. But our experience is that markets will not look through it if the earnings degradation is as severe as we think it's going to be.
Mike, I mentioned there that you see a difference between what could develop in the real economy and what could happen with earnings. How well received is that with clients at the moment, Mike?
Well, look, investors understand that concept. I didn't invent that. So, I think they very much appreciate that concept. The problem is that it's noisy. And there is this, we live in this world now where there's sort of almost like hand-to-mouth guidance, the Fed, doing it for the bond market and companies doing it for the stock market. And so it's a process that takes longer than it probably should. And that's what's frustrating, I think, for some investors who are in the weeds on this, where we are. It's like, well, my goodness, it's pretty obvious what's about to happen. Why is the market taking so long to kind of price this? That's just the way it is. And that's not a new phenomenon. That's kind of the way it always is at this stage. When you get a significant earnings recession, it just takes longer than you would think to get it priced.
Do you get more questions about single names now, Mike? And what single stock ideas do you offer them?
We do, but, I think most of our clients are pretty good at that job. They do a good job. That's their job, essentially. We absolutely help them. We do run a model portfolio. As you know, we've had great success with that. But it's a helpful tool. And then we run a lot of screens for people based on our view of the world from a macro standpoint, saying, okay, these factor variables should be in effect, and this is what you want to, kind of put in your portfolio. We run those screens, and that's kind of how we go at it. We don't, talk specifics necessarily with clients around, individual companies as much as, say our analyst team does. Which is really their job.
But let's talk about sectors, in particular with margin compression. If the service sector, is possibly seeing more, perhaps, wage pressure, need to pay more to people to bring them in the door than, say, tech stocks, how do you look at where margin compression is going to be the greatest and what could potentially get hit as people trickle through and realize this new kind of reality?
Well, that's exactly right. Now, one of the other features we just touch on for a second is that the recovery itself was sort of two-stage, right? It was goods first, then services. Normally, in a normal recovery, everything comes back at the same time. So you have this sort of rolling recovery and now rolling recession. Tech is in a recession right now. I think that's obvious, right? They're losing, they're seeing negative growth. They're laying people off more aggressively in other sectors. And I think the big question for the economy is, does that spill over into the services sector, which is where the employment really lives, right? I mean, that's small, medium businesses and services companies employ a lot more people, as you suggested. Look, we think ultimately this will roll through kind of the entire economy. Services will probably get hit later in the year when other businesses are showing weakness, and then we're seeing layoffs there, which then people spend less money. So it's sort of a circular argument, but clearly this idea of operational efficiency is what the market's paying for. So companies that are showing good inventory controls, labor costs as a percentage of cost of goods sold are smaller, and then CapEx depreciation is lower. And this word efficiency has been popping up. I find it very interesting. We're hearing it from a lot of different companies. We've been talking about that for 12 months. So people are catching on, and but we think that it's not over. We think the market will continue to pay for companies that are very efficient with their expenses and can get the revenue to the bottom line.
This is fascinating, Mike. Are you saying that in the months to come, the goods sectors that perhaps have already seen the downturn will outperform as margin pressures and some of the downturns start to hit the later recovering sectors, namely services, leisure, hospitality?
We think that could be the case. I wouldn't say that's like a high conviction view, but we do think that a lot of the goods sector stocks in particular, and even the earnings forecasts, have come down because it's obvious, right? We had a pull forward of demand, and so those numbers have been reset. The question is, what does the demand profile look like for some of those businesses that were basically COVID winners? Are they winners in the long term? That's to be determined. And then services, we do think has gotten a bit frothy, and it's gotten, there'll be demand destruction as prices are a bit out of control there. So it's just messy, and that's why I think this, our view, we do a lot of work on top-down earnings, which we have high conviction in. That way, we don't have to focus so much on trying to call the economy, which I think is a much trickier, thing to do. Calling a recession is very hard because you never know when that light switch is going to go off on employment. But when it does, it's it's immediate, and it's just there's no lead time. It's just all of a sudden it hits you. But the earnings picture, we can see out 12 months pretty good, and that's why we've had conviction there.
Mike, well said. As always, fantastic to catch up with you, sir. Mike Wilson there of Morgan Stanley. Thank you very much for being with us. Difficult moment in this equity market, Tom. Tough to call.
Tough to call because, as he said, we have not, I liked how he corrected me. He said, this is not a new regime. We've returned to an old regime. And there's just so many people on radio and television right now who've never lived this new world. And there we are, as you mentioned, with CDs.
It's funny, Tom.
Forward 5%.
And Ruskin of Deutsche Bank said the same thing about a different asset class, didn't he?
Yeah.
Yeah.
I mean, it's a whole new world after all. That's all there is to it.
You going to sing that one?
No, I'm not going to sing.
Okay, all right. Just checking. Get grumpy.
It's from Aladdin.
There you go. He's going to sing anyway.
I know, exactly.
Grumpy, honestly. Lisa Shannon, Morgan Stanley, Wealth Management coming up. Alongside Brian Niconuthi, Tom Kennedy at JP Morgan. There we go. Welcome back.
Is this grumpy?
No one can claim that climate change is somebody else's problem or shrug it off for future generations.
Connection lost.
We're all affected by a warming planet. We see that every day. And decisions being made right now will determine our shared tomorrow. So we must choose, and we must act as united nations ourselves. Our progress depends on collective action, on collective ingenuity. If we stick together, we can make fixing the climate the greatest project and greatest achievement of our lifetimes. We have the science, we have the solutions. Now all the world needs is political will. Together, we can create a future where rampant carbon is removed from the atmosphere, where green buildings and green business transform the livability of communities.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg surveillance, an interesting Tuesday here with some data with a continued market lift. Great to hear from Mike Wilson of Morgan Stanley. There's some of the nuances for some real good, Lisa, some real good equity conversation to juxtapose what Anna Hahn said with Mike Wilson shows the narratives out there are very different.
And the difficulty to really come up with some sort of cohesive narrative at a time of such a disjointed recovery. That's what really stands out to me in general, how hard it is to game out something where you've already seen a recession in tech. You've already seen a recession take hold of the good sectors, and now the services sector is booming. How do you put this together in some sort of overarching call?
We're going to talk to Dana Peterson in a bit here about the American economy, but first, and Lisa, I thought since there's been so much talk here about Chairman Powell speaking in the next hour, we would get not a history lesson, but where are we with Michael McKee, our Chief International Economics and Policy Correspondent this morning. Michael, you and I remember HHH and Augustus Hawkins of California piecing together 45 years ago an interesting bit of legislation that had hope in it. And part of that was to force the Fed at gunpoint to come out and speak more often. Back then, Humphrey Hawkins' testimony was really illuminating, listening to Greenspan and others speak when we rarely heard from them. Now they speak every 15 minutes. Your life is absolute chaos. Do we need to hear from the chairman this morning?
Not particularly. I don't think anybody in the markets is going to hear anything that they don't already know from the Fed. And because we have jobs on Friday and CPI next week, Powell can't be very determinative in what he says about what the Fed is going to do because everything could be upset by what's coming. But you're right. In the olden days, when you and I used to walk 2 miles through the snow uphill to Capitol Hill to listen to Alan Greenspan, both ways, yes, it was a big deal. And everything he said was parsed very, very closely. And that was, of course, in one of those hearings, the famous time when he said, if you understood what I was saying, then I must have been mistaken.
Mike, we have seen a shift in markets, the fears of runaway inflation perhaps tempered by this disinflationary process that was started in January, perhaps less so last month. How much in D.C. has the narrative shifted beyond inflation to concerns about economic growth later in the year?
It's really not shifted so much as it's sort of fallen into silos, and they're really based on politics. The Democrats on the Hill are very concerned about growth and about the idea of unemployment rising. The Fed's forecast is for something like 4.6%. You get that high, it's about 1.5 million job losses. Republicans are focused much more on inflation and trying to score political points, arguing that Joe Biden's responsible for that. For the Fed, it's a question of how do you know which is going to happen? happen because the pandemic upset so many of the rules of thumb that they use. It's really hard to know whether we're going to see that kind of slowdown that would create 1.5 million more job losses, or whether inflation can come down more quickly than it has in past episodes.
Do these hearings tend to reveal anything, Mike? I mean, how informative, how newsworthy have these hearings been in the past?
Every once in a while, you get a statement out of the Fed chair that is either illuminating or something that's a slight mistake that the markets will jump on. But it really doesn't get you a lot. I was kind of wondering when you were talking to Mike Wilson, no argument against Mike Wilson, but if you're an analyst, do you have to say you got something out of the Fed, or is it fair to send out a note to people that say, well, he told us what we already knew?
This is a huge issue,
where you're going to end up today.
This is really important, folks. Mike's busting my chops because he knows it's the third rail issue with me. For global Wall Street folks, no news is news. I can't emphasize that enough. When there isn't a lot of earth-shaking news, that's actually news within the continuum of trying to look forward. Mike, I got one final question, and I don't want to turn it into a fancy economic dissertation, but so much of this is based on a theory of what we will do post-pandemic with inflation. And to partition the theory, there are optimists like Olivier Blanchard that say we're going to work this out and we're going to get down to a regime that represents what we used to know. There's another group, and I will mention Ken Rogoff of Harvard, who say this time maybe we will set at a higher level. I know none of that's going to come up today, but is the Fed thinking about that?
Oh, yes, the Fed is definitely thinking about what comes next. The timing of when that next is way up in the air. But do we go back to an old normal? Do we go back to a new normal? What does it look like? And the best guess is that we're going to end up with a slightly higher inflation and Fed rate regime. They don't want to be zero again. They would like to be around 2 to 3%. And if they can get down there without causing a lot of shall we say, disruption to the economy, that's what their target is going to be. But all this has to play out over the next year or so.
Mike McKee, thank you so much. And again, McKee leading our coverage in Washington today with the testimony of the chairman. I'm always and forever going to call it Humphrey Hawkins' testimony. Dana Peterson doesn't call it Humphrey Hawkins. She calls it must listen. She listens to every single word 2 days running. She's chief economist at the conference board. Dana, what I love about your work is its consumer foundation at the conference board, maybe a little business investment as well. You are heated that measured is not 50 basis points and that we've got a measured Fed that will stay measured and stay at 25 beeps, whatever that path is. Discuss the nuance of a measured Fed versus the jump condition that some are calling for.
Sure, I think that a 50 basis point hike is actually inflammatory or would raise a lot of concerns among markets and also consumers and businesses that the Fed is losing control over inflation, at least the fight over inflation. So I think the Fed's probably going to opt for more 25 basis point hikes, probably 3 more, maybe even more greater than that. Maybe we'll get to something close to 6%. It's not really clear, but it's really going to depend upon inflation and also the labor market and whether wages are starting to cool at all. And so I think that, certainly the Fed does not want to cause alarm and will probably go with 25 basis points in terms of interest rate hikes going forward.
Dana, you've got unique visibility into consumer confidence and, frankly, consumer spending, which is the engine of this economy. Are you seeing signs of softening materially or not really, because we are seeing that kind of wage increase that a lot of people have been waiting for?
It's interesting. Consumers are divided. In terms of the present situation, they're saying, we're fine. Most of us are working. Many of us who switched jobs are seeing wage increases. We may still have a little bit of spending, a little bit of savings that we can spend. We have credit cards. We're continuing to spend. However, looking at the future, they still say, hey, we do expect a recession at some point. We're concerned about job prospects. We're concerned about the business environment, and we're concerned about our own income. So it's really a mixed picture in terms of how consumers are feeling.
How divided is it in terms of the higher income and the lower income sectors? And I ask this as you start to see companies increasingly cater to wealthy individuals who still have more than $1 trillion of discretionary savings in their checking accounts. That's according to some metrics. And then you have the others who are looking at shrinking spending capabilities. How much do you see that reflected in sentiment?
Sure, it's interesting. In the last reading, folks making between 35,000 and 75,000 were the most concerned about the outlook. And indeed, when we look at what consumers are saying they're going to do regarding spending, they're saying they're not going to buy cars or homes, and they're even pulling back on expectations for going on vacation. And that's really important because that's a harbinger of what's going to happen in the services sector.
Dana, with all of the uncertainties that are out there, to me, the great divide is the domestic economy versus foreign dynamics. And of course, we look at that subdivided into this strange thing called domestic final sales. Does domestic final sales indicate we are near recession?
Well, it's a mix. Again, consumers certainly did spend a lot of money in January. They were pulling back on consumption late last year, but then there was a big spurt. But certainly when we look at business investment, that's already starting to roll over. And certainly investment in CapEx, structures, and the residential investment environment are all weakening. And really the last shoe to fall is going to be the consumer, especially with respect to purchasing services.
Well, this is the conference board expertise. Do you see the tea leaves there of a consumer that could fail?
Well, I think that's the tough part. Our leading indicators continue to signal recession. Indeed, they say that recession should be happening right about now, but consumers are defying all expectations. So I think we really need to see the data that's going to come out for February. Certainly January was a pretty good month in terms of weather. February was horrible. March was worse. And we'll see if that's borne out in the data.
Dana Peterson, I love that. We're going to codify that. That's going to be in all of our ads going forward, Dana. February was horrible. March was worse. Dana Peterson of the conference board, thank you so much. I just think, Lisa, it's just so incredibly important to take the algebra and subdivide out, this is the American economy, and then over here is exports, imports, inventory build, and all that dynamics.
I love what she just said there. Dana was saying that their leading indicators suggest we should be in recession right now, and consumers just aren't playing along. Consumers are going to spend, and they are spending, and this has been sort of the conundrum that has continued to power this incredible growth and inflation and pricing power even in some places. It's just, when does that end?
Well, I go back to microcosm, and that each story will be its own story and not aggregated together. And you are going to have a select group of people that mint money, even in recession, whatever that level of recession is. And you're going to have a lot of others, quote unquote, flat on our back. That's a very scientific term there. And we're getting there now. We're getting some really moldy numbers out from some people, but then there's others that are like, let's go, China, 5% GDP, onward.
I'm watching jobs. That's going to be the key number for me over the next couple of weeks. Yes, CPI, but more jobs, and the number that we get on Friday. The fact that we've gotten 10 upside surprises consecutive, the longest streak of upside surprises on labor market reports from the United States going back decades to the late 90s. When you take a look at that kind of surprising upside momentum to job creation, when do we start to say we are misunderstanding something in a labor market that is unique?
I would suggest that what we're misunderstanding is the third tranche of the summit, what Blanchard calls the Biden stimulus, whatever your politics. The fact is we had a big pop, and it's there, and it's still there as it fades out over time, and that's all there is to it. Futures up 5, Dow futures up 16. The VIX, importantly, under 1918.79. Stay with us. This is Bloomberg Surveillance.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The job cuts aren't over at Facebook parent Meta Platforms. Bloomberg's learned the company is planning a new round of layoffs and will cut thousands of employees as soon as this week. In November, Meta eliminated 11,000 jobs. That's 13% of its workforce. The powerful sister of North Korean leader Kim Jong-un has issued a new warning to the U.S. and South Korea. Kim Yo-jong is threatening severe consequences if the two countries go ahead with joint military drills next week. Last month, North Korea threatened to turn the Pacific Ocean into a firing range if the exercises took place. Baker Hughes and HIF Global have agreed to develop technology to directly capture carbon dioxide from the atmosphere. HIF says that will speed up its plan to eventually produce 150,000 barrels of so-called e-fuels a day. Bloomberg's Alice Steele spoke with HIF's Meg Gentle.
We're creating a whole new industry. It's very, very simple. We're taking water and extracting the hydrogen from it, taking air, extracting the carbon dioxide from it, and putting the hydrogen and the carbon back together, you have hydrocarbons.
Supporters see e-fuel as a virtually carbon-neutral version of gasoline. It could be used to keep cars with internal combustion engines on the road for years. S&P Global Ratings has slashed Nissan's credit rating to junk. It's a blow for the Japanese automaker that struggled to boost profits in the years following the arrest of Chairman Carlos Ghosn and the industry's turn to electrification. S&P says it's unlikely that Nissan could make a strong recovery in profit and sales. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Right, but I was also basing my views on the research that indicated that front-loaded policy would be a superior strategy to achieve the equilibrium. But on the other hand, we have to remember just how strong the external forces of inflation are or have been. And so, although I'm vindicated, I also recognize that the external forces were going to be there anyway.
An American in Paris, well, no, not Paris, London, but we'll go with it. Catherine Mann of the Bank of England and also of superb international economics in America. Just a bang-up job for the Bank of England. She's been a hawk, which people are surprised, but given her efforts at MIT years ago, I guess I'm not surprised that Catherine Mann is towed a tough line.
It's interesting to see how the doves have become hawks. This idea that people who had erred on the side of not doing as much are now saying this is a different scenario given the inflation.
What's important here is to understand that if you do equities, bonds, currencies, commodities, all sorts of good things can happen. And what's great is at any given firm, the guy who's the quote-unquote fixed strategist, it's always their fault. It's you know, if it's equities, okay, you can Mike Wilson, just equities, partition that. But if you're a fixed strategist every day it can be your fault.
Yeah, even worse, you're supposed to know what's going on at a time when it's very difficult to do so. Ian Steely understands the angst of that very clearly. He is international CIO for fixed income at JP Morgan Asset Management and joins us here in studio. And I'm so glad that you are, Ian, because I'm really struck by what Robert Holtzman said, the ECB Governing Council member this morning, that he potentially backs raising rates in Europe by 200 basis points more this year, potentially 450 basis point rate hikes. How outlandish is this? How much is this starting to actually gain traction?
So he's probably at the more hawkish end of ECB members. But I think the reality is the ECB have still got the inflation problem to deal with. So everyone over here is well aware that core inflation is coming down, albeit slower than the Fed would like it to be. That's not the case in Europe. You know, core inflation continues to move higher in Europe. The way the mix of core inflation is likely to be calculated over the coming months, it's going to continue to move higher. So the ECB, who were behind the curve, who were slower to the party of rate hiking than other central banks, is playing catch up, and it feels like they're going to have to go a little bit harder. Although I think we need to be clear, this is probably the top end of expectations.
The top end, perhaps extreme top end. That said, this comes at a time when so many people have been bullish on Europe. They've seen the surprise of a warmer than expected winter. They've expected to see perhaps more growth in tandem with inflation. Do you push back against that?
No, I think that's right. I think Europe has. I mean, there were big concerns about Europe last summer, the gas problems and the hikes. I mean, the Bundesbank, I think at one point was saying Germany could fall 5% GDP. And obviously that hasn't transpired. And now you've got an environment when Europe's coming out the other side, the gas tanks are much fuller than was expected come the end of the winter. And people are seeing a really good cycle out of Europe. And again, that goes into the problem the ECB's got to deal with. They've got the growth, but they've also got the inflation, and they're going to have to keep going.
Ian, coming out of the pandemic, and you've got one of the toughest jobs at your shop, and that is just simply looking across FIC, across all of commodities, currencies, and fixed income, and such. What do the correlations look like for next year? How predictive or how tight are the relationships of fixed income, commodities, and currencies right now?
I think what you're going to see is you are going to see, obviously we saw a big correlation last year, not just, I think importantly, not just in FIC last year, it was across fixed income, across equities, everything was going down in price. And I think we are going to see a bit of a difference this year because of the huge repricing that we saw last year in fixed income. Yeah. And then you've got, as I say, some central banks which are much further ahead. You've got, say, the Bank of Canada, who are likely to pause this week. You had a bit of more dovish message out of Australia overnight. You know, the Fed, there's a decent amount priced in now, and then there's the ECB and other central banks.
Whatever the relationship is, and I don't even want to go in, we don't have time here to go into, fancy talk, but do you assume that the dampening going through 2023 and 2024 is a normal, what's called synodal dampening, where we're just going like this, easing our way along? Or are we going to see more abrupt jump conditions within the relationships of fixed income, currencies, and commodities?
I think we're going to have a slower journey or a more smoother journey than we saw last year. Outside of the European Central Bank, I think the central banks want to slow down the pace of hiking, which is going to bring down market volatility. And then it's going to be a case of later in the year, how high do rates get? And then do we have to do some sharp decreases if we do start to see a slowdown?
And Lisa, this is just critical, the extension of the x-axis out, where people, and particularly financial media, were always like, what's June look like? And the real question is what does 2025 look like?
Exactly, especially once you've worked through some of this reset. Going back to this idea of the rate hikes that you're talking about, why haven't we seen more spread risk in Europe? Why haven't we seen more contagion really feeding through to the peripheral spreads, the peripheral bond yields that typically would blow out in this kind of situation?
So I think there's a couple of things there. I mean, firstly, we did see that concern around spread risk in Europe last summer, when we had these big concerns around a slowdown. And as we've come through that and the slowdown hasn't materialized and economic growth and strength looks better in Europe, people are getting a bit more confidence around Europe. And we've seen that not just in peripheries, we've seen that in credit spreads, high yield spreads. They've basically come back down to pretty much be in line with where the US is trading. But I think you've also got a much more joined up Europe than I can really ever remember, with the recovery plan in place and the coordination that we've seen across Europe. So it feels that we haven't got that sort of spread risk, the periphery risk that we've seen through previous cycles and that we've all come to know over the last decade or so. And if that goes away, then actually there's some decent yields on offer owning some of these bonds.
Which is fascinating at a time when a lot of our guests come on and they say, you know, perhaps people have overplayed the euro and people are perhaps overseeing what's going to happen with the dollar and the potential strength later on. Do you push back against that and say not only do you have upsides risk with respect to ECB rates, but also the strength, the resilience can maintain that?
I would say both of those, and I would also add just the flow dynamic. So if you think about what's been the case of Europe over the last decade, negatively yielding bonds. I mean, who wanted to invest in Europe? Who wanted to buy negatively yielding bonds? Well, that's not the case at the moment. You know, two-year Germany now at 3%. You're getting north of 4% across the Italian curve. You're getting 7.5% across the European high yield mix, and that's before you even move into the dangerous world of equities. So I think there's just a lot of demand that will come back into fixed income. People who haven't wanted to own European fixed income for a long time.
Where on duration are you then? I mean, you know, on a global basis, is there comfort in the belly? Do you have to go short term? I'm hearing that you don't, or can you actually be brave like the equity people and extend out duration?
So I think you still want to. So we're still playing for the curve to actually flatten a bit further from here. We think there is still concerns that the central banks around the world maybe have to do a little bit more that's priced. Although the repricing that we've seen over the last few weeks has been very helpful. And then really it's the back end of the curve that gives you that ballast in a portfolio. Right. That's the bit of the curve that will do very well if things go badly and suddenly fixed income yields move higher and the capital gains could come from that part of the market.
I mean, can I ask? Okay, I will. Ian, I'm asking for a friend. Then you load the boat on the 97-year Austrian peace right now, down 71% from its peak. I mean, do you extend duration out? 97 years?
So that is, I think that now is, we were looking at it last week, I think that is now at the lowest price on the 100-year bond there.
Thank you. We noticed that earlier. Yes, we did notice that. Continue.
So I think, obviously, then you've got to take into account that's obviously the European curve where there must possibly more still going through from an ECB standpoint. I think in the US, if you want to go out and you look at the 10-year part of the curve and you're 4%, maybe it goes to 4.25. I can't see it going a huge amount higher than that. And that means that over the next few years, that looks like a decent investment. And I think, you know, buying bonds, definitely more attractive than they were at any point last year. And thankfully, the rally that happened in January has reversed a bit to give us another opportunity to go back into the market.
Don't be a stranger, Ian. Lovely to see you in our New York studios. You know, so was that enough bond talk, Bramo, for you?
So I'm looking right now at the Austrian 100-year bond.
Oh, are you?
And it's trading at 41 cents on the dollar.
Yeah, well, I bought it like at 114.
Yeah, exactly. It was up there at one point and is no longer.
Yeah.
Trading at 41 cents on the dollar.
Yeah, well, I bought it like at 114.
Yeah, exactly. It was up there at one point and is no longer.
Yeah. There's a lot of people doing that. I mean, this is serious stuff. We had a guest, folks, a couple days ago saying basically fossils are going out and they're buying coupon. They're being maximum yield hogs. And they're just saying to their kids, you take the price decline down the road.
Yeah, well.
That's not a small issue.
No, I remember when I was a kid, my grandfather giving me some treasuries and basically handing me the certificates.
You got a 14%
yeah,
coupon treasury?
Well, and he had bought them a long time ago. It was a great deal. It wasn't, this is bad. It was actually a really good thing.
You sold it because you needed a new transmission in Fargo, right?
Well, let's not talk about that either.
It is an interesting day ahead here. In an hour, I believe, testimony. And, of course, the important headlines that Michael McKee will give you of a testimony of the chairman of the Federal Reserve System. Futures up 4, the VIX 18.79. I can't look at the Austrian price. This is Bloomberg.
From our studios in New York and San Francisco, our new hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech at a new time, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, starting Monday, March 13th, only on Bloomberg.
Today, what are the biggest challenges for General Dynamics and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. You know, the problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? You know, the why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible, and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
So what is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO. So buy high, sell low. You know, and the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
Chairman Powell testimony about 60 minutes away. Live from New York City this morning. Good morning, good morning. Equity futures positive by about 1/10%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
From New York coming up, Chair Powell facing down the Senate Banking Committee. China pushing back as the U.S. seeks to contain Beijing, and Meta gearing up for thousands more job cuts. We begin with the big issue, the Fed chair on Capitol Hill.
We have Jay Powell's testimony against Congress.
We're going to hear from Chair Powell today, tomorrow.
Senate Banking on Tuesday, and then House Financial Services on Wednesday.
Everybody's going to be going through this with a fine-tooth comb.
Is he moving in a more hawkish direction? Is he going to move more toward what the terminal rate is now being priced into markets?
I think they'll stick to the script.
He will underscore the fact that inflation continues to be their main objective.
But the real problem is what the Fed are looking for is the data, and Powell isn't going to have the data.
We've got key data coming up.
The payrolls report on the 10th.
We're certainly all beholden to the data at this point.
The proof is going to be in the pudding.
What actually happens in terms of the questioning of Powell is another thing.
59 minutes away, and the countdown starts right now with Morgan Stanley's Lisa Shallett and Nuveen's Brian Nick. Lisa, first to you. We hear from the chairman in about an hour. Do you expect him to validate market pricing?
Yes, I do. I think he's going to talk about the fact that the bond market appears to be moving in the right direction, which is acknowledging the Fed's conviction in a higher terminal rate and the reality that we are not seeing cooling in the real economy yet. And we're not seeing enough progress on inflation. Again, I think for the average American, which is what the folks in Congress are going to care about, they're going to focus on the headline inflation, and that's still over 6%. And that's, as we know, 3 times their target.
Brian, are you looking for the same thing?
Yeah, I think one thing that the Fed has accomplished, or really allowed the data to accomplish forward, is sort of goading the market up to where the Fed's own forecasts were, at least as of December. And they're likely to go a little bit higher in March in terms of the terminal rate. But 4 weeks ago, Chair Powell was unable to get markets to tighten up in response to that last FOMC meeting. It was really the subsequent data, the payrolls number from January, as well as the CPI data and a couple of the consumer spending reports that have really gotten the market's attention and alerted investors to the fact that rates are going to have to go higher, perhaps to as high as 5.5%, or some economists think quite a bit higher than that.
And Brian, now, as you've just pointed out, the market's above the Fed. We've gone from the market below the Fed to above the Fed, and I'm trying to work out when they sit around and put together a dot plot, Brian, at the end of March on the 22nd, what do you expect that dot plot's going to look like?
I think the average terminal rate is going to rise. I think it's going to be more in line with the market. I think the Fed probably is pretty happy with where things are. It would prefer to deliver dovish surprises than hawkish surprises, I guess, at the margin. Getting the market to price in a 5.5% terminal rate, I think makes a lot of sense. There are going to be a lot of dots above 5.5%, but my guess is that that median dot's going to be somewhere in that 5 3/8 range.
Elisa, it's super tricky for the Fed chair to navigate this because this conversation, of course, could completely change on Friday with the payrolls report, could change again on the 14th with the CPI report, and that CPI report comes on the 14th in the quiet period before the Fed meeting on the 22nd. I would go back to some comments he made in the last news conference when he said the disinflationary process had started. Lisa Shallot, you said he'll validate market pricing. Will he de-emphasize that phrase he used early on this year?
No, I don't think he will. I think he will stick to his guns on this idea that the disinflationary process has started. And I do think he can lean on the data in that regard. I think the key is going to be the questions that he gets from congressmen who, as we know, they're there to represent their constituents. They're just going to go right for it. And they're going to say, do you feel that you're making, progress quickly enough? Can you execute a soft landing, et cetera? And I think that the chair is going to try to continue to suggest that is their intent. He's going to take a victory lap on the fact that the labor market is still so strong. But I do think he's going to have to continue to say that inflation is still too high.
Brian, we always tee this up as a bit of a grilling, a face down, a showdown between the chairman and officials on Capitol Hill, and then it gets there and it just turns into a YouTube clip that's being made by a politician to send out to their constituency. Should we expect anything different today?
Yeah, I'd say less of a showdown, more of just a show. The congressmen are there also to get their point across. I think Powell's going to get a lot of pushback from Democrats on the unemployment forecasts, which the Fed has not had a chance to update since December. I assume they're going to go down in March. But they're going to be asking him, why do you think unemployment needs to be 4.5%, 4.6% by the end of this year? And is getting inflation down to 2 or 2.5% really going to be worth that? And he's going to need an answer for that. He's also going to need to be able to explain how it is that higher interest rates getting to 5.5% or even 6% is going to bring down inflation in a way that going from 0 to 5 so far hasn't managed to do.
Mike McKee's down there in Washington, ahead of all of this. Mike McKee, what are you focused on?
Well, exactly that. How do they get to where they're going and what are the impacts? If you take a look at the chart that shows where inflation and unemployment are right now, you can see the Fed's dilemma. The Fed is looking at the yellow line, which is PCE inflation, still too high. The white line is where the Fed is now. The dotted white line is where their December 14th dot plot suggests they may go. And the blue line is where unemployment is and what would happen if they went higher. And that's a little corner of the chart over on the right-hand side is what all the argument is going to be about today. Powell is going to, as you guys were talking about, along the lines of we're looking at very small moves. Maybe he'll say 25 at default, but he 50 if they need to. If the data still yet to come suggests that the Fed is behind the curve. And then, as you were talking about, and Lisa was talking about, a lot of questions, a lot of pushback from the Hill today. Is the 2% inflation target still justifiable? Could you do 3? Would it make a difference? How many people will have to lose their jobs? If they go to 4.6% unemployment, as they forecast in December, that's 1.5 million jobs gone. Will there be a recession? When or how bad? Did the Biden administration cause the inflation? That's the Republican question. And are Republicans threatening debt ceiling disaster? That's the Democrat question. So there will be, I think Brian put it very well, a show. Whether it's a showdown or not, we don't know. And whether we get a whole lot out of it, we don't know. But Jay Powell will tell them what most people already know.
He'll spend 2 hours today trying to avoid the politics, 2 hours tomorrow trying to avoid the politics. Mike, he's also got to navigate a tricky point, and you and I have talked about it. This is ahead of payrolls. It's ahead of CPI. How much two-way risk do you think there is in the data? How is he going to approach all of that?
Well, this is such a weird time. We don't know how much risk there is, but the assumption is there's a lot of two-way risk in there. Payrolls were seen as driven by seasonal factors and some unusual post-pandemic statistical situations in January. So there's a feeling they're going to come down, but how far do they come down? And then in terms of inflation, we were making progress. We bumped up again in January. Do we start to go back down again? The Fed sees disinflation in a lot of categories. Do we get the disinflation the Fed's looking for? So Powell can't go too far out on a limb without knowing those numbers.
And Mike McKee, thank you. We get those comments from the Fed chair in about 52 minutes from now. Lisa Shallett, Brian Nick back with us. Lisa Shallett, we've got to take this framework, all this Fed speak, all this good stuff, and plug it into markets. A number of months ago, you said there was a massive disconnect between the bond market and equities. What does that disconnect look like now?
It's gotten more severe. I mean, I think that that's probably the biggest thing that concerns us is that equity investors are behaving in an extraordinarily complacent way during a period of time when the risks, and as Michael said, the two-way risk we see is extraordinarily high. I don't think, I had a mentor, at the beginning of my career, Michael Goldstein, who used to say, nobody knows nothing. And that's where we are at the minute. You've got the New York Fed, forecasting, or the Atlanta Fed forecasting a nowcast for GDP for the first quarter, close to 2.5. And you've got the St. Louis Fed, saying, it's going to be a recessionary quarter. I mean, nobody knows what's going on. There's a lot of cross currents, and that's what's not priced into the equity market. There seems to be this belief among equity investors that companies are, quote unquote, going to make the numbers no matter what.
Is that an argument to sit in bonds or sit in cash?
For me, I'd rather get paid to wait. I don't want to take the risk. The market's already up, 5.5%, 6% year to date. I don't want to take the risk right here for an incremental, 2 to 3% when I could easily have 10 to 15% downside. It's just not a good risk-adjusted return for me.
Brian Nick, would you take the other side of that?
I wouldn't. I agree with Lisa that unfortunately I think a lot of the gains that we're going to see in 2023 may already be in on the equity side. On the fixed income side, if I'm looking at an alternative to equities, I'm probably not looking at cash or government bonds. I'm probably looking more at things like high yield, where you can get paid 8-9% for a below investment grade exposure in fixed income. Trades more like equities, but at least you're getting the yield, which you're not getting provided with the equity market. And the economy holds up relatively well, but profit margins get squeezed, which I gather is sort of the Fed's goal here in bringing down inflation. Then it's possible you're going to see outperformance across fixed income compared to equities over the balance of this year.
Brian, with a spread of 390 on high yield, what do you make of that?
Yeah, it's come down pretty aggressively. I think what we've seen, one thing we've seen in common between the stock market and the bond market this year is that recession risks have gotten priced out, at least imminent recession risks have gotten priced out pretty aggressively. So you've seen that yield curve even kind of uninvert a little bit for certain terms. You've certainly seen the 10-year a little bit better supported, and you've seen the stock market valuations better supported. I think all that goes to the likelihood of a recession risk receding a bit, and that is also consistent with the decline we've seen in spreads. But we still prefer less rate risk and the wider spread you're getting with high yield compared to the higher quality, but the lower spread and the more interest rate sensitivity with investment grade.
Elisa, you said you didn't want to take on the downside risk in the equity market. What about the high yield market?
We've been cautious there as well. Our sense is that those spreads are just too tight. We think that the canary in the coal mine is going to come in the credit markets. Thus far, Markets have held extraordinarily well. Cash flows have remained resilient, and we've been able to cover. But our best guess is that as we're starting to see these little pieces of news, coming out of the commercial real estate markets on some selective defaults, that's really where you're going to start, getting some warning signals. And, we'd prefer when you look at the spread between, high yield and investment grade, that's pretty tight too. So, I'd rather play quality here, versus an incremental 30 or 40 basis points of yield.
Elisa, there's a phrase you'll hear a lot of in the equity market. People will say things like valuations are full. There is a question worth asking, Lisa, at what point you would look through that, look past all of that. When is that point?
Yeah, so, for us, and I know you read a lot of work from the team at Morgan Stanley, what we have said very clearly is we're looking for an equity risk premium to expand by about, 200 basis points. We're looking for a price earnings ratio that's a lot closer to 15 to 16 times forward. Look, we can get there in a variety of ways, but we need to just see better valuation here before being interested.
Well, clearly right now in this equity market, you don't believe we're there at the moment. Equity futures are just about negative, turning positive briefly. Let's call it flat on the S&P 500. On the NASDAQ, we're positive by 0.1%. Lisa Shallett and Brian Nick there. This from Marko Kolanovic at JP Morgan, who put this out just yesterday, said this: while the day-to-day interplay of investors, speculators, the options market, systematic investors, etc., can produce strong rallies, we maintain that risk assets are in a bear market and will not bottom until central banks start cutting rates. We'll pick up on those comments around the opening bell in just a moment. As I say, about 16 minutes away, equity futures on the S&P totally unchanged. Yields in a couple of basis points. Your 2-year, 487. We topped out last week north of 490. Your 10-year, above 4% last week. In fact, the whole curve, 2's out to 30s, 4+% through much of last week. Your 10-year back below that level to 395 on a 30-year, 388. Should we get you some movers ahead of the opening bell? Let's do that. Here's Abby.
Hey, John. Well, let's take a look at a stock that is popping. That, of course, is Meta. Shares are up nearly 2% on a Bloomberg exclusive reporting that the company is said to be cutting thousands of jobs this week. This is on top of the 13% reduction back in November. That equaled about 11,000 jobs cut. That was the first big layoff ever. The goal, of course, is efficiency, so investors liking the possibility that it is going to help the bottom line. What stands out to me the most about this stock, John, on the year into today, up 53%. We're obviously only about 2 months into the year. That, of course, though, follows a greater than 60% decline last year. As for one stock plunging on the day, we, of course, have Cara Therapeutics down 25%. The biotech company, their fourth quarter revenue missed. They put up a wider loss than expected. This is stoking concerns about demand for their kidney disease drug. JP Morgan sticking with their overweight. There is a 12% bearish short interest on this stock. The range for this stock over the last roughly 9 years, John, between $4 to $30. This binary trading, the worst day today since April of 2021.
Abby, thank you. Coming up on this program, Congress looking to crack down on TikTok.
I got 12 senators, 6 Republicans, 6 Democrats that are co-sponsoring this legislation. Gives the Commerce Department a new set of tools to take on up to banning TikTok as well as other hardware, software, mobile apps.
That conversation up next.
So intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it's very different, and it's not something people have had to operate in for a long time.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
They're collecting data. Many of those folks are young people. They are also, this is an enormous propaganda tool. The Chinese Communist Party can direct what type of videos you're seeing on TikTok. So I think what our bill does gives the Commerce Department a new set of tools to take on up to banning TikTok, as well as a host of other new domains where we're going to see foreign technologies, I believe, pose national security concerns.
Washington, inching closer to ban the Chinese video sharing app TikTok. Democratic Senator Mark Warner gearing up to unveil the bill, which the White House is poised to support. President Xi rallying the nation today, saying that China has been grappling with, quote, comprehensive containment and suppression by Western countries led by the US. The foreign minister adding to those remarks, the United States' so-called competition aims to contain and suppress China in all respects. It is a reckless gamble, with the stakes being the fundamental interests of the two peoples and even the future of humanity. Let's get down to DC with Anne-Marie. AMH, some strong words there.
Yeah, tensions rising, Jonathan, between Washington and Beijing, and yet another bill. It doesn't name TikTok in name, but it is another bill that can go after TikTok that will be hitting Congress as soon as today. And what we've heard from Senator Warner, he is one of the co-sponsors of this bill. He says it has bipartisan support with 6 Democrats, 6 Republicans, is that this would give the Commerce Department more tools to mitigate these concerns when it comes to technology, that they're worried about national security concerns. So this could be to go as far as prohibiting apps like TikTok, but also software, hardware, AI computing technology, all of this. And it really is an expansion of an executive order that was from the Trump administration given to the Commerce Department. What's interesting about this bill, when you look at a handful of these bills, is that it does seem to be that this has White House backing. But of course, as you just read out what we heard from Qin Gong, the foreign minister of China, whether or not it's Xi Jinping calling out the United States directly recently, this is just going to add to these tensions and the acrimony between Beijing and Washington.
Anne-Marie, do you think the rhetoric matches what you see in the bill? Within the bill and many of these bills, as you've pointed out, TikTok is not named directly. And as you've pointed out also, this would give the government, the administration, the ability to pursue banning the app if they wanted to. But if they truly believe that this is a tool for propaganda, that there is an intelligence risk associated with this, why is there even a conversation right now?
Well, there is another conversation that is going on that doesn't always get the front page headlines. First, I would say we need to read the text of this bill, which hopefully this afternoon we will have in our hands. But there's another conversation between the executives at TikTok and CFIUS and the U.S. government. TikTok maintains that they can still operate safely in the United States because they would be able to isolate the data. This is going to cost them a ton of money, and it's called Project Texas. They're using a similar format dealing with the European Union, who's also concerned. So potentially, if you look at the intelligence of it and that the community, they may say that at the end of the day, if they were able to isolate this data, this is something that can happen and that they would be comfortable with. The other issue, Jonathan, we talked about this in surveillance, is that this might not bode well for under 30 voters. TikTok is incredibly popular. The younger the youth get, this is where they are getting their news. This is why, though, you have Republicans and Democrats concerned that China could potentially rejig the algorithms, but this is not going to make lawmakers in Washington popular.
Yeah, that shouldn't be a consideration if they're truly worried about an intelligence risk, but I'm not going to go there anymore.
Well, it's politics.
I get it. I get it. Last week, you and I talked about BlackRock, companies like that getting squeezed between blue and red states over fossil fuels. This development right here, AMH, I think is one of the biggest economic stories potentially for our future. Just a breakdown across this country between what red states want from corporate America and what blue states want. And in the last 24 hours, California looking to ban business with Walgreens. You saw the tweet from Governor Newsom, who said California won't be doing business with Walgreens or any company that cowers to the extremists and puts women's lives at risk. We're done. Now, AMH, just briefly, I don't know how much business the state of California does with Walgreens. What are they saying back to this?
Well, John, this comes down to the abortion pill, which is the flashpoint of partisan politics since we saw the overturning of Roe v. Wade. Yes, last week we talked about ESG, but this is a medical issue. And what you see is the state of California taking aim at Walgreens because what Walgreens had said previously, which is that they will not sell this pill in 20 states. But those 20 states that they can't sell those pills because those attorney generals say they're going to get sued. Very complicated story and difficult for Walgreens right now. And
something I imagine you and I will keep talking about. Anne-Marie down in Washington, AMH, always appreciate it. Thank you. Up next, the morning calls, and later, JP Morgan's Tom Kennedy looking for the 10-year Treasury yield to hit 285 by year end.
Transparent to the shopper before they accept an order, what the order is going to look like, how much we're going to pay them, and how much like the consumer is paying them, and so they can decide whether they take an order or whether they refuse it. And that's the kind of flexibility that our shoppers really value and the kind of transparency that they want.
Are you seeing a labor shortage right now, and what are you doing to combat that?
It's different in different places. Our demographic of shoppers is completely different from food delivery and ride sharing. We're 70% women and half of them are moms. And that's because a lot of the job at Instacart is very different than just being in a car with strangers. It's about like going to the store, doing a good job of customer service, of really picking the right products for the consumer. And we are seeing that being very appealing to women.
Was going to keep rate World Cup. This is a 3.
As the economic picture does.
Is the OK is getting ready to make.
4 minutes away from the equity market open, futures totally unchanged. Let's get you some morning calls briefly. First up, Evercore upgrading Delta to outperform, expecting the airline to benefit from China's reopening. Your second call, North Coast Research upgrading Costco to buy, saying quarterly results have set the stage for a strong second half. And finally, Argus upgrading DraftKings to buy, seeing upside as more states legalize online sports betting. That stock is up 2.6%. Up next, Tom Kennedy at JP Morgan, looking for a big move in this bond market.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Chairman Powell, Fed Chair, 30 minutes away on Capitol Hill, and your equity market doing absolutely nothing going into the opening bout. Futures unchanged on the S&P and the NASDAQ, unchanged as well on the Russell, unchanged as well. To see a theme emerging here as we wait for Chairman Powell and his comments. There's your opening bout, switch on the board and get to the bond market. Yields not doing much either, basically totally unchanged on a 10-year, 395.58. In the FX market, euro dollar not giving me much. We're down about a third of 1%, 106.50. Amazing to hear some of the comments from Holzmann, the National Central Bank Governor of Austria, in yesterday's session, teeing up, pushing for 4 more 50 basis point hikes from the ECB. I get it, he's an outlier, he's super hawkish, but the fact is, that's going to be part of the conversation on the Governing Council later this month with him pushing his agenda. My question is, they'll go 50, okay. Will they tee up and commit to another 50 basis point hike at the same time as saying we don't do forward guidance? The whole thing's ridiculous. Crude right now, holding on to 80. We're down 0.4%. WTI $80 and about 14 cents. We are 40 seconds into the session. Your equity market opens up like this on the S&P, dead flat on the NASDAQ, unchanged. That's the theme right now as we wait for Chairman Powell, 29 minutes away. One stock to watch at the open, Dick's Sporting Goods. The company's forecast topping estimates and sounding confident it has resolved its supply chain issues. The CEO said this: as planned, we continue to address targeted inventory overages, and as a result, our inventory is in great shape as we start 2023. Abby has more. Hey, Abby.
Hey, John. Well, shareholders really rewarding the stock right now. Dick's is popping more than 5%, the best day of the year since last December. And of course, it does have to do with that outlook. They also put up a solid quarter. They saw a second quarter of same-store sales growth, that after 2 quarters of declines last year. And that, of course, had to do with those inventory issues and perhaps also the macro around the idea that last year there was expectations for a big recession. Consumers slowed down, but up 5.5% in the fiscal fourth quarter that ended in January. As for the quarter that was, not surprisingly, they beat top and bottom line estimates, not by a huge margin, but there was a beat, really reiterating the idea that demand for sporting goods items, well, it is in place. And that outlook, as you mentioned, they raised it. They also more than doubled the dividend. So good things here for Dick's Sporting Goods. As for the stock on the year, it is outperforming. Right now, it's after today's
actually, this is the one-year view, up 42%. Now, Hibbett, a smaller competitor, is a little bit higher, and Big Five is down. But on the year, Dick's Sporting Goods is beating these other two stores, really blowing away the competition, especially after these results, John.
Abby, thanks for that. We're also watching the airlines as well. JetBlue and Spirit said to be facing an antitrust suit from the DOJ as early as today. JetBlue responding in an email to Bloomberg, writing this: "We believe there is a high likelihood of a complaint from the DOJ this week. We have always accounted for that in our timeline to close the transaction in the first half of 24. Kaylee has more. Hey, Kaylee.
Hey, John. Yeah, so they anticipated a bit of regulatory pushback here. That isn't to say, though, that investors weren't a bit surprised by this. You saw that reaction really yesterday when Spirit shares were down the better part of 9%. But here at the open, a little bit of a rebound taking shape, now up about 1.3% in the first few minutes of trading. JetBlue, for its part, is up by about 0.5%. I would note that this isn't just about the Department of Justice filing suit against this $3.8 billion takeover, that they are expected to file that in federal court this week, alleging that the elimination of Spirit would increase ticket prices and decrease options for travelers. But also, the Department of Transportation is expected to begin a parallel proceeding to block the transfer of Spirit's operating certificate as incompatible with public interest. That is largely unprecedented in the modern era, John. We haven't seen the DOT use its authority to block the transfer of a certificate like that since 1978. All the way back when the airline industry was deregulated. So this is really significant here. And again, it all comes back to the availability of discount flights or cheaper flights for consumers on different routes. All of that said, though, even if JetBlue and Spirit ultimately succeed in combining, they will still make JetBlue only the fifth largest U.S. carrier based on domestic traffic. So it is still smaller than the likes of American, but nonetheless, the merger here of these two could give JetBlue more pricing power that will ultimately impact how the other major airlines have to change their prices as well, John.
Kelly, thanks for that. One to watch. You'll be covering it, no doubt. That stock is up by a little more than 1%. One call to have a look at, Evercore, upgrading Delta to outperform, seeing an improving backdrop for the airlines. The analyst had this to say: fuel prices are behaving, China's reopening is a positive development, and recent pilot contract negotiations has lowered Delta's cost outlook uncertainty. The stock's flying year to date, excuse the pun. Delta up another 1.9% in today's session. Elsewhere, from airlines to automobiles, Rivian shares under pressure after announcing plans to raise more than $1 billion through the sale of green convertible bonds. That stock is down 7.6%. Ed Ludlow has more. Hey, Ed.
Yeah, good morning, John. The downward pressure on the stock reflecting that issuing convertible bonds can potentially have a dilutive impact on the shares outstanding. As our colleague Joel Levington in Bloomberg Intelligence points out, this kind of shores up the liquidity story around Rivian, which ended the fourth quarter with around $12 billion of cash, cash equivalents and unrestricted cash on its balance sheet. But investors have had concern about the rate of burn that this company is going through as it ramps up production. The green angle, also interesting, of course. This is a maker of electric vehicles with longer-term, broader ambitions around the transition to clean energy, but it does add to an existing debt pile, these green convertible bonds due in 2029. The issue of converts is kind of interesting to me, right? For investors, this is an opportunity to get an interest payment with, the right but no obligation to convert to shares. For Rivian, this is taking advantage of a cheaper means of raising funds amid higher interest rates. But look to the equity story, right? And that share performance on a 12-month basis or more, you kind of get why they might do this, John, instead of just going directly to the equity markets. An interesting situation for Rivian, and they're kind of following others in this space. I'm thinking, of course, of Lucid, that look to the same mechanism.
Looking forward to your coverage on the tech show later, Ed. I just wanted to squeeze one in just to follow up to our conversation earlier this week. The price cuts again at Tesla. How are people responding this time around?
Yeah, look, earlier price cuts in the year unlocked pockets of demand. What I would say about the Model S and Model X is very low volume production, 100,000 units just out of Fremont, and they're still very expensive. There's an interesting debate about the rationale behind it, given that they're still outside the scope in some sense of the IRA tax credits. But, this is a lever that Tesla's using. Other automakers are following suit, and the outperformance of the shares year to date to some peers suggests that analysts in the street see it as a useful mechanism to find those pockets of demand, particularly here in North America.
Tough year last year, massive year-to-date gains this morning, down about 1%. Ed, thank you, sir, as always. The broader market looks like this, 7 minutes in unchanged on the S&P, slightly firmer, stronger, higher, positive on the Nasdaq, up 0.2%. Tom Kennedy at JP Morgan has this to say on the bond market. We expect the Fed to keep hiking rates by 25 basis points until payroll growth slows materially to less than 100K monthly payroll gains. We expect that criteria to be met as we approach mid-year. Tom, I'm pleased to say, joins us right now. Tom, great to catch up with you, sir, as always. 23 minutes away from Chairman Powell. If I looked at the January data alone, reported in February, I'd look at that and say we are not sufficiently restrictive. When you look at the complete picture, Tom, are we?
Good morning, John. Yeah, I do think we are restrictive. Powell has used this word, the disinflationary process, and to some degree, John, the market has said, oh, wow, this is the immaculate disinflation we've been expecting. But really, when I hear Powell talk about that, I think he's really describing the road to recession is about halfway paved. What I mean by that is we're getting every indication that rates are restrictive in America. And the things that I look at, number one is the housing market. You have this rare situation where construction completions are higher than construction starts. And you can imagine if you're a builder and you're completing 10 jobs and you're only rolling crews over to maybe 8 jobs, layoffs will happen. Second is in the capital investment or corporate CapEx space. Capital availability is quite low and suggests CapEx will continue to deteriorate. And then lastly, you're finally starting to see auto and credit card delinquencies pick up, albeit very low levels, John, but there's good reason to believe the disinflation process is well underway because we're getting firm evidence that higher interest rates are restrictive here.
So, Tom, when you look at a downturn, anticipating one, it's the 3 Ds, depth, duration, dispersion. Can we just deal with the third D there, dispersion? Are you seeing that weakness spread as the months go by?
Yeah, I think this road to recession, or really road to layoffs, John, is non-linear when the Fed is tightening rates. Housing and tech are very, quote-unquote, interest rate sensitive. Construction and housing, I think, is obvious when you have a short mortgage cycle. But for tech, we had a decades-long equity availability of capital, and that's been shut down by the Fed as well. So those are going to feel the impacts first. But, John, if we're sitting in Powell and team at the Fed, what do they really want? They want more broad-based layoffs. I think the sectors we should be looking most at are construction, manufacturing, and unfortunately finance jobs to see evidence of progress along that roadway.
Claims, as you know, 190. The last jobs report, 517,000. Unemployment, 3.4%. The estimate for this coming Friday, I've got the estimate right now at 224 in our survey. That's a moving target, of course. That's the median estimate in our survey so far. More estimates will come in, but let's go with the 224. You're looking for sub 100K, in your words, as we approach mid-year. Tom, what is it about the glide path that you see? What's important about mid-year?
I think what's important about mid-year is you'll have a long duration period, almost a year, of positive real interest rates and restrictive financial conditions that take time to move through the economy. John, this week, expecting 200,000 jobs added is really a continuation of the slowdown in job growth we saw in the back half of last year. It does suggest January was the anomaly. I think there's good reason to think that, too. It's very rare historically to see 500,000 jobs added in a month. I think we naturally all should have a statistical asterisk on there. But I think the deterioration is just a continued roll through of slow CapEx, and companies do billions of dollars, like JP Morgan, billions of dollars of CapEx every year. If we're slowing our CapEx, revenues for others are starting to slow. We're in step 3 already. This is step 3 of the roadmap. And what am I really describing is a world where earnings deteriorate. Q4 of last year, average S&P 500 earnings are down 5%. This is underway. I think it will just take more time. And then step 4 is where you actually see businesses defend their margins. I'm expecting that around mid-year, John, but this resiliency piece that you're highlighting may push that out a little bit, but doesn't mean it doesn't happen.
We're having a conversation about recession at the same time David Solomon speaking at an event over at Goldman Sachs. It's an RBC conference. The Goldman Sachs CEO says a chance of a soft landing is meaningfully higher. Tom, you have to confront both sides of the debate each and every time. You also have to look at the menu in fixed income at the moment, 2s out to 30s, and make a point that you want to advocate for purchasing somewhere across the curve. Tom, as you put it all together, the debate, arguments on either side, look 2s out to 30s. What do you like on that yield curve right now?
I like to have some sort of duration for my clients because, John, first and foremost, they don't have much of it. I want them to be adding and locking in yields here because I do see those rates as restrictive, and by definition, if they are restrictive, they'll go down in the future. It's a simple conversation with a client, John. It starts like this. Do you think a 5% T-bill is attractive for your portfolio? Unanimously, I see yes. Okay, well, why wouldn't you want to lock that in for, say, 5 years? And it's just a way to start to engage them of what do you want your money to do for you? And finally, John, for the first time in 15 years, we can help clients reach their portfolio goals with less risk. So ultimately, I want them to be adding duration, and in our community at JP Morgan, it ends up looking like a 5-year municipal or investment grade bond.
And maybe even looking for 285 on a 10-year by year end. So let me take that argument for bonds. Tom, if that's an argument for a 10-year, is that an argument against equities?
I don't know that it's necessarily so, John, let me say no. You can have equities for your appreciation and bonds for your confidence in your portfolio total returns. So you can own both. I think for the marginal dollar spent here, it's fixed income far and away. The earnings yield on the S&P 500 is about the same as a 12-month T-bill. When you show that to a client, well, the S&P has some risk and T-bill really has negligible risk. So how can it be marginal dollar spent in this risk bucket? So I just think you have to give people this what's in the price concept and let them see the value for themselves.
Tom, just a final one. The chairman in about 17 minutes' time. Members of Congress do watch this program, and if someone from the Senate Banking Committee is watching right now, or maybe a member of the House Financial Services Committee for tomorrow, what's the question you'd like them to ask?
I'd want them to know, I want Congress to ask the question about confidence in the progress. And I would like to see Powell really emphasize this disinflationary process being underway as progress towards the layoff cycle, not progress towards immaculate disinflation.
Politically, let's see how that argument goes. Tom Kennedy, thank you, buddy, over at JP Morgan. Appreciate it, as always. About 15 minutes away from hearing from Chairman Powell. Coming up on this program, another round.
Overwhelmingly, the tech sector is overhired. There's probably more redundancies coming from all of the big cap tech going forward.
Meta is gearing up to make another move. That conversation up next.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
Going to name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but you know, some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city. It's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It is the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
The top names at the Fed are on Bloomberg.
Inflation's normalizing, but it's coming down slowly. I just think there's going to be a lot more inertia, a lot more persistence to inflation than maybe we'd all want. I'm hearing people still out there pushing price and trying to test where the levels of inelasticity really are. As the meetings go on this year, we'll see what happens. If inflation settles, maybe we don't go quite as far, but if inflation persists, maybe we'll have to do more.
Nobody covers the Fed like Bloomberg, your global business authority.
The stock market rewarded them for growing, attracting users, not generating profit necessarily. And I think Facebook or Meta has acknowledged now that it's more of a value company than a growth company, and focusing on the bottom line, creating efficiencies. Those are value company techniques to create shareholder value. And I think that's what Meta is being forced to. But overwhelmingly, the tech sector is overhired. Basically, to achieve that growth that the market was rewarding, there's probably more redundancies coming from all of big cap tech going forward.
Meta planning a fresh round of layoffs. Bloomberg reported the company is looking to cut thousands as soon as this week. This coming on top of a 13% reduction to its workforce back in November. The CEO, Mark Zuckerberg, saying at the time, "I view layoffs as a last resort, so we decided to rein in other sources of cost before letting teammates go." Overall, this will add up to a meaningful cultural shift in how we operate. We'll roll out more cost-cutting changes like this in the coming months, and here we are in the month of March. Ed Ludlow, you helped break this story. Can you help explain to us where these job cuts are going to drop across the company?
Yeah, broadly, what we're learning from sources is that director and vice president level staff have been instructed to draw up lists. And as you said, Jonathan, those layoffs could come in the next week as those lists are finalized. What we know from one source is that Mark Zuckerberg himself is due to go on paternity leave. His wife is expecting their third child. The hope from those management level staff is that those lists are finalized and those layoffs conducted by the time that happens. There is also a financial target that we're told, and that's interesting because the context here is the bloat of the pandemic era, right? And one gauge that we've been tracking is the additional units of revenue added per additional headcount over the pandemic period. If you stack Meta alongside its mega cap tech peers, Meta's pretty firmly bottom of that pile in terms of the new revenues they were able to add by growing staff in the pandemic era. We know that they've added subscription, a level of subscription tier for some of their products. I reported last Friday, John, that the impetus for cutting prices on the AR, VR headsets was simply a lack of demand. They're not able to sell any. So there's a lot of pressure to make this happen, and what we're hearing is that it will happen soon. It will be pretty broad-based. I'm told by one source those original 11,000 cuts at the start of the year were very forensic, very planned. What I'm told this time around is it's more of a sledgehammer approach. They have to meet these targets. They have to make these additional layoffs, which are separate to the 11,000, separate to that management flattening, and it will be strong.
What a change. What a change for this company in the last 12 months. Ed, thank you, and tremendous reporting, sir, as always. Thank you, buddy. Thinking about these tech cuts, still not showing up in the broader labour market at the moment. Jobless claims still in at around 190. Looking ahead to payrolls, if you missed that number a little bit earlier in the programme, sneak peek of payrolls Friday, the estimate so far in our survey, still north of 200,000, 224,000. The previous number was just a blowout 517. This is what Chairman Powell has to confront in about 9 minutes' time. He's got to look for the data on Friday in payrolls, and then CPI on the 14th drops in the quiet period, ahead of the Fed meeting on March 22nd. He's going to face 2 days of questioning from lawmakers on Capitol Hill, 10 a.m. in front of the Senate Banking Committee. That's about 8.5 minutes from now. Then on to tomorrow at 10 a.m. Eastern Time, again in front of the House Financial Services Committee this time. Mike McKee's back with us for a final word. Mike McKee, looking ahead to this one, your focal points, what you are really, really looking to narrow down on with Chairman Powell later, what are they?
Well, I'm going to pick one thing, John, and that is why hasn't unemployment risen even though the Fed has raised rates by so much? You talked about jobless claims not moving. Will they start to move soon because people who have gotten severance are no longer getting it and they can file for claims? Will companies suddenly start to lay people off? That'll be an interesting question to get Powell's answer to.
Mike McKee, looking forward to it. 8 minutes away from that testimony on Capitol Hill. We will, of course, bring you those headlines and that testimony right here live on Bloomberg TV and on Bloomberg Radio. Just like we were going into the open, coming out the other side, your equity market is going nowhere. The S&P 500 totally unchanged on the NASDAQ positive by about 0.2% or so. Yields come in a single basis point at the front end. Your yield now 4.87 on a 2-year, on a 10-year, just short of 3.95, down a single basis point there at about 3.94-ish. Let's get you some sector price action. Here's Abby.
Well, once again, John, we're looking at anemic volume, but the S&P 500, as it flips ever so slightly higher, up for a 4th day in a row, potentially the best streak since the middle of January. It's all about the mega cap tech sectors that are leading today. Communication services. Actually, we have utilities sneaking in there. Consumer discretionary higher. Dix, I should mention, hit a record high earlier. To the downside, though, we have energy and materials. And over the last year, you were mentioning those David Solomon headlines. Over the last month, I should say, banks, interestingly, down, even though yields are sky high. John, this could have something to do with banks now having to give money out on deposits.
We'll see if that develops just a little bit more. Finally getting some interest in the bond market, some real income. Up next, your training diary, Chairman Powell, 6 or 7 minutes away.
Did art conservation help you in any way to be a better investor? And should a lot of good investors who learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of work, pre-work, before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. Lots of testing, lots of thinking about what could go wrong, lots of research. When I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of, like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
This is Bloomberg.
So these are the scores going into Chairman Powell. This is how the stage is set. Equities totally unchanged on the S&P 500 on the session, on the NASDAQ positive by about 0.25%. In the bond market, not too different. On a 2-year yield, we're down just a single basis point. On a 10-year, similar move. That's the price action. Let's get to that trading diary. Top of the hour, Fed Chair Jay Powell kicks off 2 days of congressional testimony. ADP jobs numbers, monthly jolts, that comes out tomorrow. President Biden releasing his budget proposal on Thursday. Governor Kuroda's last BOJ rate decision on Friday. And finally, the main event, it's payrolls coming up on Friday. Before we get there, it's the chairman of the Federal Reserve, 4 minutes away.
you're so intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it's very different, and it's not something people have had to operate in for a long time.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg. I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the NBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them, to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the number fever campaign. Del Fierro thought Pepsi's number fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113A, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue a warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning 1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack of the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Benegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Benegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Benegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Benegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Weinergold as an opportunity to leave that troubled home. Weinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environments, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if they, if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the danger, the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. Asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
Kind of imagine in the future maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers. One of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities and the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't, and the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people like want to unpack that. And so my audience is, a lot of them are younger investors who are looking to hone their skills.
Tech and right up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just like attacked that video and were like, you explain things so much better than my boyfriend or my professor, or like I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwits, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I